they can hear us on the Zoom?
Yes.
Okay. Great. Could we call the roll?
Totally. Treasurer Laura Montoya.
Good morning, President.
Nick Tejas.
Present.
Catherine Allen.
Present.
Don Bingaman.
Present.
Ellen Sanchez.
Present.
Rich Summer.
Present.
I think I got everybody.
Kelly O'Donnell.
Pardon me?
Kelly O'Donnell.
Kelly O'Donnell.
Present.
That's 7. We have a quorum.
Okay. Next item is approval of the agenda. Is there a motion to approve the agenda?
So moved.
Motion by member Summer. Is there a second?
Second.
Second by member Sanchez. Please skip the roll call vote and consider it approved. Okay. Motion to approve the minutes from the October 29th SIC meeting.
So moved. Second.
Motion by member Allen, second by member Summer. Any objections to approval of the minutes of the October 29th SIC meeting? Okay, then let's move on to, we'll consider that approved and move on to our SIO briefing, item 2A.
Thank you very much, Mr. Chair and council members. Because we have a long agenda, I'm going to be very brief and just cover 2 quick things. The first is I just want to note for everyone that our investment committee meeting in January is going to be on Wednesday instead of on a Tuesday. So it's going to be on Wednesday, January 22nd. And then the second thing is just want to remind council members that our strategic planning retreat will be next Monday and Tuesday, December 2nd and 3rd, at the New Mexico State Library, just off of Cerritos. We are rushing to try to get the packet put together to send out to you all, but we're hoping to get that out to you later today. It should be a great agenda. It's the culmination of feedback from all of you on what you wanted to see at the strategic planning retreat. And we hired a moderator with tremendous experience. She has decades of experience as a moderator, but specifically as a moderator for strategic planning discussions. And she's going to be helping put together the strategic planning document that will come out of this. So there are going to be a few things that we'll be focused on. The first is have the council discuss and then vote on a mission statement and goals for the organization. And then we're going to move into a presentation by national experts on models of how investment institutions around the country and around the world operate, what might make sense for us, and then there will be plenty of time for council members to discuss and decide on perhaps a timeline for taking a look at who we are, who we want to be, how do we want to get there, and what that time frame should be. And then on the second day, we're going to start off with a presentation from McFarland, which is a group that we hired at the request of the governance committee several months ago to do a compensation study. There's going to be a broader discussion of staffing issues and what staffing looks like at some of our peer investment groups by a national expert. And then we're going to have a presentation on risk management. And so I think it's going to be a great agenda. Look forward to having you all there. And if you have any questions about it, please reach out to me anytime between now and leading up to the event itself. But with that, Mr. Chair, I'm happy to answer any questions.
Any questions from the council or State Investment Officer?
Mr. Chairman, just 2 points to ask our director. Good morning. On the January 22nd, I have it on the calendar that the 21st is the CIC meeting. Is that not correct?
Mr. Chair, Madam Treasurer, there was a conflict, so we had to move the CIC meeting from that Tuesday to Wednesday, so it is now on Wednesday, January 22nd, at the same time of 1:30.
Oh, perfect. So the SIC meeting is still the same on the 28th?
Mr. Chair, Madam Treasurer, yes, the SIC meeting is still the same, correct.
And as far as the agenda that you're mentioning for the retreat is from what time to what time on Monday and Tuesday?
So, Mr. Chair, Madam Treasurer, it starts a little with an optional breakfast beforehand that runs from about 7:45 to 8:15, and then starting at about 8:15, we dive into the materials. On the first day, we are slated to end at 4:45. On the second day, we're slated to end at about, again, 4:30, 4:45. It'll partly depend on just how long some of the discussion takes. We tried to make sure that we weren't going to come up short on time for discussion, but it might be that we're able to end a little early both days.
Great. And will we be getting an agenda for that today?
Mr. Chair, Madam Treasurer, yes, we're going to definitely send out the agenda today, but we're hoping to send out the whole packet of materials to all of you today as well.
Okay, thank you. And where is this going to be located at?
So, Mr. Chair, Madam Treasurer, it's going to be at the New Mexico State Library, which is near the SPO building just off of Cerrillos, and we'll have the complete physical location listed on the agenda. I will note it is an in-person meeting only. It's not going to be streamed.
Okay, thank you very much. Thank you, Chairman.
Who was on the agenda?
12:09, Carlos. Yep, meeting will be at 12:09, Camino Carlos Rey. Would it be possible to just, set an 8:30 start time for that meeting? Sounded like it was a little squishy, and 8:15, and just to.
Mr. Chair, we can try to do that. We do have, people lined up for some specific start times, but we can try to adjust that to happen.
Okay, I would appreciate it.
I would, Chairman, I would keep in mind some of us are coming from out of town and have babies that keep us going until we can get there. So I might be a little late, just so you know, but since there's not a Zoom link, I'll get there when I can. Thank you.
Understood. Thank you, Madam Treasurer. Any other questions or discussion on the SIO briefing today?
Chairman, can I just ask you one more question? I wanted to stay away from the Capitol because I didn't want anyone to be worried they'd get sick before the holiday. But how many people do you need to have a quorum?
Mr. Schiff?
6. We currently have 7.
Okay, thank you, Chairman. I'm going to try to hang on as long as I can.
Thanks, Madam Treasurer. We hope you feel much better soon. Any other discussion on the SIO briefing? Hearing none, we'll turn to our CIO briefing with Mr. Smith.
Thank you, Mr. Chair. Well, I'll follow John's lead and be short for you so we can get to the big part of the agenda here. We're wrapping up the year here with the holidays, and pretty much we've seen this year what we expected to. So last January, we talked about how presidential election years tend to have a certain rhythm to in terms of markets and the economy, and we pretty much got a standard issue year. So the stock market's pretty good. In fact, got a little bit better than good through the stock market this year. Economy was pretty even and steady, throughout the year. Interest rates were well controlled. Fed stayed out of the way. We had just the one interest rate cut prior to the election. We kind of thought they may avoid that, but they did a 50 basis points there in September. So pretty much what we expected for the year. As we move into the first year of particularly a new presidential term, administrations tend to take their pain up early. We could have some rougher waters starting in the new year, and we wrote about that in the annual investment plan. In fact, not just next year, but the next 2 or 3 years. Things could be a little tougher. We just haven't had a proper recession since 2008, 2009, and that's just not good for the economy to have it manipulated such that we just don't get those cleansing recessions. So when it does come, particularly with market levels as high as they are now, at record levels, in fact, on the stock market, could have some rougher waters. But as you know, looking at the portfolio through your statements and things that we give you, the performance reports that we give you, very strong positioning in terms of liquidity, very, very high ability to take advantage of talked a little bit in the investment committee meeting that as of December 2nd, which will be the first business day of next month, we will have 9 of the 12 permanent funds either at their long-term asset allocation target or within the rebalancing bands around the long-term asset allocation target. So it's been a ton of work. But as John pointed out to me this morning, it's not the big fund. So we still have land severance and ECE to go. Still lots of cash on the balance sheet that needs to get put to work as we get capital draws from the private side. Sure would like to see a nice dip in the stock market so we can get some money to work there. So we're comfortable about that. And again, we think that's probably coming. It's probably on the plate for next year. But still, very, very fine liquidity position. Interest rates are high enough that we are getting a good rate of return on both excess cash and bonds that we hold outside of the long-term asset allocation for those three funds. So I think pretty good shape. I think you'll find some good news in your performance reports when we get there later in the meeting. That Marcia and Matthews go through and the rest of our consultants. And so with that, well, I guess one other note, we've been starting to work on a couple of new projects the strategy group has in terms of where do we go from here. So we've talked an awful lot in the last 2 or 3 years about how globalization's done. That's been going since really since the end of the Second World War, but in particular since the early 1980s up till about 2008, 2009, when we started to roll over a little bit. But looks like globalization's done. What comes next? Some of the folks we're talking to and some of the theories we're starting to develop here a little bit, leaning toward sort of a modern version of mercantilism. That's probably the most prevalent economic system historically, at least in a more modern world. And we think maybe moving towards something modern version of mercantilism. It works for some of the larger and older countries. We talk in this room a lot about demographics, and one way to deal with an aging demographic would be a more mercantilist approach a country can have. And that's just the government getting more involved in picking winners and losers, or backing winners and losers, and trying to develop foreign policy around economic power. That's one way to deal with an aging society that's no longer just, there as a consumer society. So we're working hard on that, talking to a lot of folks, different folks about it, and we'll have plenty of reports down the road, I think, along this. So with that, Mr. Chair, I'm happy to take questions.
Thank you very much. Any questions for our Chief Investment Officer?
Mr. Chairman, I do have a couple of questions. Thank you for recognizing me. Good morning. I would like to know on the legislative side, that might be more of a John question, but potentially Vince, what are we doing for the legislative session? Are there any bills that are coming out of SIC, or have we heard any positive conversation back from Legislative Council regarding any potential trust funds that they might be creating to make sure that they put the money in the correct place, whether it's with SIC or with the State Treasurer's Office? So I think that preparation and what we need to do as council members to be prepared for that session would be one question. And the second question would probably be more for Vince as it relates to liquidity. We do have a lot of liquidity, but with the talk of the cost of tariffs and other items, what are we seeing, or what do we need to prepare for? What are some of the consequences or unintended consequences of things that need to be prepared for with either the liquidity or whatever we have already invested as it relates to some of the subject matter that the President-elect has mentioned he's planning on doing?
Mr. Chair and Madam Treasurer, for your first question, so we have heard a few legislators talk about the possibility of wanting to set up other funds with us. I have not heard them progress to the point of seeing draft legislation, so I'm not sure how serious those were. So we may see additional ones, but it didn't seem like any of them were really moving along to the point of definitely seeing introduced in the session. However, we do expect a couple of bills from the Legislative Finance Committee. One, we would be part of the overall cleanup bill, just trying to for example, make sure that definitions are consistent, not making actual policy changes, literally just cleanup. But the Legislative Finance Committee had also mentioned that they might run a bill that would cap the New Mexico program at a lower percentage than the current 11%, and that they might also cap the amount that goes to the New Mexico Small Business Investment Corporation, SBIC, at a lower rate as well. It's currently at 2%. So that is possible. They did consult with us about how much funding is currently available. Right now, there is room below both of those caps. Neither the New Mexico program nor SBIC have fully utilized the entirety of that. So we did share with them the numbers of what that looks like. But at this point, we don't know exactly what that legislation looks like, and we'll take a look as soon as that gets introduced and let the council know.
And
Can I just, before you go to that next point, on the idea of the New Mexico Fund, and I'm also on SBIC, how do you feel about it, the decrease for the New Mexico Fund? Or what does that do for us, or how does that impact the total dollar amount? What are we talking about dollars wise?
So, Mr. Chair, Madam Treasurer, I don't have the dollar amounts in front of me, but right now we're at probably about half of our target that's set by the council, which is 9%. So we're well below the 11% maximum that's allowed under statute. And that's something that I discussed with legislators during our budget hearing. And they recognized that we were making very prudent decisions in that regard, but several members mentioned that they would just have an additional level of comfort if statutorily that cap was a little bit lower. But we can get you the numbers of what that would look like, and of course we can provide that when we find out what the bill actually says and what they're trying to reduce that to. And then as for the SBIC program, I had a chance to meet with the director, and they have plans for how they want to try to get to their cap. But because the severance tax permanent fund is increasing so rapidly, it is increasing at a rate that the SBIC has never been able to grow at. So it would be an unprecedented rate of growth for SBIC to be able to achieve. The Legislative Finance Committee staff know that. They have historical information. I don't know what percentage they might put in for that. They were at 1% and were brought up to 2% at the start of this governor's administration. I don't know if OFC would want to go back to 1% or something in between. But again, we'll bring that information to the council's attention as soon as we see what that looks like.
Thank you.
And I think, Madam Treasurer, just quickly on your second question, if I were to just personally rank order the risks that I see out there in terms of our portfolio, it would be geopolitical risk would be at the top. So the war in Ukraine, the Russian-Ukraine war is taking a little bit of a nasty turn here in the past few weeks. We all read the news and know what's happening there. That's really concerning. So I would rank that at the top of the list in terms of causing a problem. Second might be, a poor economic performance in Europe, probably energy and debt-led troubles in Europe. That could turn into a global recession on us pretty quickly. At least wouldn't take a lot to push Europe over, that's for sure. I'd say third is right here in our own country. The price level is here in the United States is just still too high for the majority of our people. They're still struggling. And that causes social angst that, can turn into economics and financial market trouble. I'd really put policy, government policy in the new administration last, and really, with the Republicans now having both the House and the Senate, that's likely just the last 2 years. Typically in the midterm, one side or the other flips to the other side, whoever's not in power. So really, it's just a 2-year window there that I think we'll have to watch policy to see if that's going to have any kind of negative effects. So in particular, the tariffs that we're talking about. So I would rank policy as last among those other 3 or 4 things.
Mr. Chairman and Vince, the other question I was thinking about in my sleep is what a percentage of agriculture do we have in our portfolio?
How much agriculture did you say? I don't know the number off the top of my head, we do have exposure. Keith, do you, or Rob?
Low single digits, neighborhood, probably 2-3%.
Okay. Did you hear that, Madam Chair? 2 or 3% of the real return portfolio.
Okay. So one of the, to my question earlier, it was more of thinking like the specifics of policy items that could somehow impact different portions of the portfolio. So for example, the tariffs would be one of them. The other one would be if there's any displacement of agricultural workers, how would that affect us or the portfolio? So for me, it's the bottom line, how policy work or how decisions will the portfolio in general that maybe we could prepare for, or we can, as a council or even as elected officials, help guide the discussion to make sure that we're keeping our portfolio sound. So just wanted to hear what your thoughts were on that.
Well, I think probably what Keith, half of our ag is outside the country. It's in Argentina and a pasture land to farmland conversion strategy. We do have some exposure here in the U.S. And do we still have Australian exposure? We may have some exposure in Australia. So that fund still may be there.
So that gets me to one last question, Chairman. You're just making my brain go all over the place today, Vince. So the exposure that we have out of the country, depending on what those relationships look with our country, what exposure would that could that potentially negatively impact our portfolios?
Well, yeah, Madam Treasurer, the main way foreign investments affect our portfolios is translated through the currency. So if a country that we've got investments in has comes into currency issues, that can affect our returns. But typically in fact, just about all we're invested in developed countries where rule of law exists, and those investments are relatively safe in terms of a sovereign problem. It's mostly currency changes that affect the business.
Thank you, Chairman. The last thing I would say, just because we do also manage some of the money with SIC, we're letting all of the boards, councils, and commissions that invest with the State Treasurer's Office keep in mind that interest rates are, as they decline, the amount of money that the interest earned that will be made every month will probably be a lot less than what people anticipated this last year. So that's just something to consider. I know it's been a great relationship, good partnership, but we're just letting all of our participants in the LGIP know that as rates move, so does the shift in the interest earned. Thank you very much. Appreciate it.
Thank you, Madam Treasurer. Any other discussion related to the CIO briefing?
Mr. Chair, before we leave this whole section of the agenda, just like to note, we did just change the agenda for the retreat so that now both days there's an optional breakfast starting at 8 a.m. and then the actual work of the retreat starts at 8:30 both days.
Thank you. All right, hearing no further discussion on the CIO briefing, we'll turn to our investment matters and portfolio recommendations. I guess I'll recognize myself for item 3A, the investment committee report. We had a meeting of the investment committee last week. All 4 members of the committee were in attendance. Treasurer Montoya also joined us for a portion of the meeting. Appreciate that. The committee went through each of the voting items on the agenda today. The committee unanimously approved the recommendation for each of the investment voting items on the agenda today, with one exception. There was some discussion about the key person risk, identify the materials related to the FDA Apartment Opportunities Fund 9 commitment. 2 of the members had some concerns about that item and just wanted to flag it for the full council, so we did not move a recommendation on that item. Unless any members have any questions, I'd suggest we turn to item 2B, Bonfire Ventures.
Mr. Chairman, before we get started, one question, just noticing, we usually have RVK speak to us before we have recommendations. Do you know why we changed that this go round?
Madam Treasurer, I'll recognize our investment officer.
Mr. Chair.
We wanted to get the voting items up first because we are concerned about losing the quorum.
Did you hear that, Madam Treasurer?
You wanted to try to keep a quorum, is that what I heard?
Correct, yeah, just a limited attendance today. I think the desire was to just make sure that we could get through the voting items while we maintain a quorum.
So I would just point out, I prefer to have RVK speak before I make decisions on hundreds of millions of dollars, because RVK gives us the rundown of where we're at within each of the portfolios and what we should be looking at. So their presentation actually helps guide my decision making of what we're doing on the individual deals. So I understand that for today, but it just makes me a little bit uneasy because I didn't get to hear what RVK said at the investment meeting when I jumped out of that meeting. So just to point out for the council's perspective, because we're not in it day in and day out, RVK is the consultant that works for the council that gives us the guidance before we make those decisions. So just something to point out, Chairman, for this meeting.
Thank you, Madam Treasurer, and I'm sure the staff will take that into account in structuring future agendas. With that, I guess I would recognize Director Cassidy.
Thank you. So this month we have 4 investments in the private equity program. We'll try to keep this moving given the long agenda. We have 3 investments in our national program, 2 early stage venture funds and a secondaries fund, and an exciting investment in the New Mexico private equity program. Starting with Bonfire Ventures, the first 2 are seed stage funds. This is part of a big effort in the national program to get exposure to early stage venture capital. Bonfire is one of the best seed stage, if not the best seed stage, B2B enterprise software fund in the country. They're based in Southern California, but they also invest across the country. I'll pass along to Richard to talk about the fund in more detail.
Thanks, Chris. Thanks, Mr. Chair. We have some venture capital funds that we're presenting today that we're really excited about, and these are new relationships for the national program. And market conditions has made it so that we can get sizable allocations in these funds as well. So we're seeking $45 million for Bonfire Ventures 4. This fund focuses on early stage venture capital investments in enterprise software companies, which has been one of the more attractive areas to invest. Bonfire started in 2017. But both of the co-founders, Jim Andelin and Mark Mullen, have previous experience in venture capital investing and in building software companies. The firm added a 3rd full-time partner during Fund 2, who brings experience working with startup software companies. From a strategy standpoint, the fund typically targets seed and Series A financing for companies, typically as the lead investor. We found the strategy that they've been operating at Bonfire fairly consistent with what they were doing previous to Bonfire as well. To find potential investments, the firm utilizes the partners network across the U.S. with a particular focus on Southern California. And post-investment, the partners really utilize their operational experience to help these companies and the management teams create value. They particularly focus on things like building teams, governance, sales, market strategy, and fundraising. Performance has been mostly strong across the prior funds, with venture-like returns and top quartile rankings against the venture capital benchmarks. Fund terms are consistent with what we've seen with other venture capital funds, with a couple terms that are more LP friendly. We're recommending a commitment of up to $45 million to the fund, and I'll turn the time over now to Jim Andelman, who's the co-founder and partner.
Thank you very much. And Mr. Andelman, just could ask to keep your remarks relatively brief, and I'm sure people can have some questions for you.
Sounds great.
Great.
Glad to be here. Thank you for your consideration. Bonfire, as mentioned, is raising our 4th fund, Bonfire 4. But Bonfire is effectively a merger of 2 predecessor firms. I founded and ran my own venture capital firm in 2005, Public Venture Partners, and my co-founder founded his own firm. We joined forces in 2017 to form Bonfire. So between the 2 of us, with a sort of 100% attribution, this is actually our 9th seed fund that we are launching. We spent 20 years refining a well-defined strategy that consistently drives outsized returns. Seed funds can take longer to season than your average VC fund because our entry point is the earliest. And 3 of our first 5 funds are top decile on net TVPI and net DPI, total value over paid-in capital, and distributions. We exclusively invest in B2B software companies. These days, AI is fundamental to the product being brought to market in about 70% of the investments that we make. And our goal is to be the very best choice for talented B2B software founders. So that expertise is really core to our model, that tight focus on that. We're typically leading a first priced financing called Series Seed. Seed provides the lowest entry prices because you're getting in earliest, and therefore the best potential for the highest cash-on-cash returns. Though we are a seed fund, we employ a low volume, high conviction, high support model at seed. This is differentiated. We have an investment team of 6 and then 3 operating support. And we only make 9 or 10 new investments a year. So I, as an individual partner, am making 2 or 3 new investments a year. And that is very important to our brand promise. Our goal is to be founders' most trusted investor advisor. Their first call when they have a question or struggling with an issue or have a question. That's not something you can mandate in documents. That's something you earn by being the most responsive, the most trusted, and the most expert. Each of the 3 partners has over 25 years of experience in and around B2B software. I'm in my 24th year of VC. I started in the Bay Area with a growth stage fund leading enterprise software called Broadview Capital Partners. Way back, I graduated magna cum laude from Wharton undergrad and first in my class at Dartmouth. My co-founder, Mark, was a senior partner at a merchant bank called Daniels & Company, doing both principal transactions and advisory for over 25 years. They sold to RBC, and then he started the seed fund that was the predecessor to Bonfire. And we were 2 of the very first seed funds in Southern California. Our third partner, Brett, spent over 25 years as a software executive, including 12 years reporting directly to Mark Benioff at Salesforce, which is arguably the most successful SaaS company in history. Brett was their first VP product, their first VP marketing. He was global SVP worldwide field operations, running all sales, marketing, and services. We're a very disciplined firm. We do what we say we do, and it drives both very strong reputation with founders and superior outcomes. In a survey of founders, the most sound methodology in existence is called Founder's Choice. We are rated top 10 globally, regardless of stage and regardless of geo. As rated by the founders' direct working experience as VCs they rate. That is what convinces founders to choose us for reasons other than price. We don't invest in a company unless we believe there's a clear and logical path to over $100 million in annual recurring revenue, such that each investment opportunity has the potential to materially impact the returns in the fund. In every single fund since our inception, including the predecessor funds, we've had at least one company that is achieved a valuation or an exit in excess of $1 billion. And that makes each of those individually a fund returner. Some good examples, a company called The Trade Desk. We invested at seed. That company went on to go public. Currently has a $60 billion valuation on $2.5 billion in revenue. We distributed after the IPO. Had investors held until today, they'd have gotten a 1,300x on that portfolio, and it returned 1.5 times its fund by itself. That focus on growth and fundamentals, combined with attention to entry prices, helps us really outperform. With our next fund, we'll be employing the same playbook, the same team, and expect to drive the same results. Thank you.
Thank you very much. Any questions related to Bonfire Ventures 4? Any questions on the phone? Okay, hearing none, is there a motion?
Yes. Move based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK. I move that the State Investment Council approve a commitment of up to $45 million to Bonfire Ventures 4 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms, and the conditions and completion of appropriate paperwork.
Thank you. Proper motion from Member Summer. Is there a second?
Second.
Second from Member Allen. Can we take a roll call vote on the motion, please?
Treasurer Laura Montoya,
Yes.
Nick Tejas, Yes.
Catherine Allen?
Yes.
John Bingaman?
Yes.
Kelly O'Donnell?
Yes.
Alan Sanchez?
Yes.
Kurt Summer?
Yes.
That's 7 in the affirmative, motion passes.
Thank you very much. On to item 2C, Blair Hippo 9.
Mr. Chairman, before Mr. Cassidy starts, can he give us a rundown, or RVK give us a quick rundown on where we're at in total, how much money we have in cash that needs to be sent out for the national private equity and for the New Mexico private equity, just so I have a little bit of perspective on the deals that we're making today?
Madam Treasurer, thanks for that question. If Mr. Bauer or Ms. Beard could provide a little bit of insight on that topic, we'll move on.
In total cash, there's still approximately $4 billion in total as of 9/30. But when you look at the relative underweights, Brent, that's there. You can see here, private equity is underweight 2.3% relative to the interim target for land grant, and slightly higher percentage on severance. You can see underweight to those both respective funds. Those are going to be your largest allocations in terms of dollar terms higher. And keep in mind, that's the interim target. As you look out a little further down the road to the long-term target, more of an aspirational target of 15%. So that will take some additional time, and you see the delta between those two is an additional 3%. So that 2.5% that you're seeing in the red bars below, you could add another 3% in terms of long-term, where the private equity allocation should be for those two flagship funds.
Thank you.
Very much. Really appreciated the conciseness of our first presentation. So as we continue with that and move on to item 2C.
So the second investment this month is, we're recommending a $40 million commitment to Larare Hippo's 9th fund. New York is now the #2 ecosystem in the U.S. and globally. Larare Hippo has seen that development over the last 15 years when it was set up in 2010. It's a generalist fund run by Ben Larare that has built one of the best networks in New York among startup founders. I'm so excited to recommend this one. I'll pass it to Richard.
Thanks, Mr. Chair. Well, Bonfire had the West Coast focus. Now we have Larare Hippo, which has the East Coast focus, specifically New York City, along with the rest of the U.S. as well. This firm is led by 3 managing partners that average more than 15 years of experience as venture capital investors and company operators. And for a fund of this size, I mean, the firm really has a lot of resources on the investment team. They have a 3-person platform team to help companies post-investment, and they've really built a strong reputation in the industry, given the length of time that they've been investing. This fund is expected to target pre-seed and seed investments across multiple sectors within technology. Given their history, a sizable amount of deal flow is starting to come from repeat founders and former employees of portfolio companies. They also focus on creating value post-investment, particularly focusing on things like talent, marketing, communications, network, events, and resources with their portfolio companies. I think another note, too, is the firm has been really disciplined in growing their fund size over time, which we like to see given the area that they focus in the investment stage. The track record's been generally strong across multiple funds. The terms are similar to what we see with other strong venture capital funds in the market. And with that, Mr. Chair, I'll turn it over to Ben Larare.
Thank you. Thank you for having me, and sure, point taken on going efficient. Well, thank you all very much for having me today. I'm really excited about hopefully beginning this relationship. I'm Ben Larare, one of the founders of the firm. I thought I would just give some sort of my background and the firm's background intermingled. I'm from New York. I grew up in Manhattan. I went to school in
Philadelphia at the University of Pennsylvania and graduated now 20 years ago and came back to New York at a time when the startup ecosystem was really incredibly small, which was somewhat shocking considering New York sort of dominant position in many industries. But I started a company out of school, a consumer business in the digital media space, and really as a product of being a founder in a market that actually had a very small startup community, I knew all the other founders, and that became the source of my deal flow in the early days. And what started as making some small, somewhat haphazard angel investments in friends ultimately became launching a fund. Our first fund was $8.5 million. The idea was invest in people who I think traditionally might have wanted to go work on Wall Street, but instead were being drawn into starting technology companies in New York. And the story of Leader Hippo has really mirrored the story of New York's growth. And so our first fund was an $8.5 million fund. Our next fund was a $20-something million fund. Our following fund was a $30-something million fund. You can keep following this forward. We've grown very organically along with New York, but our strategy has remained incredibly consistent, which is that we are exclusively pre-seed. You often see the sort of definition of early stage expand as funds want to justify larger and larger AUM and start to move into Series A or Series B. We think that there is a very specific product to be built for 0 to 1 for founders who are beginning of their journey. Our process is highly focused on talent, and we believe that talent will take us into very interesting markets. And so New York 10, 12 years ago was highly concentrated in consumer, lots in media, lots in commerce and sort of commerce adjacencies. As New York has grown and as big tech, the Facebooks and Googles of the world have built large offices in New York, you've actually seen the talent pool shift, and real engineering talent has come to New York, and you've seen the markets that New York births companies into splinter, and our portfolio expand with that. And so, again, as we're a true generalist strategy. Today, we're a 20-something person team, all New York-based. My two managing partners, other two managing partners are Eric Hippo. Eric was a former operator. He was the CEO of a company called Ziff Davis, a large media business that was owned by SoftBank. He took that company public, then went and ran the U.S. venture program for SoftBank, Vision Fund. Those of you who know what the Vision Fund is. He then led the Series A in the Huffington Post, joined Huffington as CEO for 6 years, sold that business in what at the time was a very big, sort of prominent New York exit, and then joined in Fund 2. And my other partner, Graham, also had worked at SoftBank in a previous life. Graham, before that, had started his career at Polaris Partners in Boston, hitting the phones, cold calling companies, meeting thousands and thousands of companies. In the early years of his career, he is a true sort of career investor, a real student of markets and models, very deliberate decision maker. He tends to do almost exclusively B2B investing. On the far other side, I tend to do more consumer. As a former operator, the business that I started many years ago, I scaled to a few $100 million of profitable revenue, 800 employees. I sold that business, and I tend to be sort of more impulsive, more highly founder concentrated, and the rest of the team sits somewhere in the somewhere between the bookends of Graham and I. And so we think New York is at an incredibly exciting point in its growth. Obviously, I'm sure AI will be a topic of conversation today, but we think New York is an amazing place to specifically build application layer AI businesses, and we think we're doing our best work today, and really happy to be here.
Thank you very much. Questions from the council?
Mr. Chair, this is Nick.
Member Tejas.
I just wanted to comment a little bit on how impressive Fund 1 through Fund 5 looks in terms of the the multiples and the net IRR. Can you talk a little bit about how you were able to achieve those pretty high statistics there?
Yeah, absolutely. And to that point, thank you for that. We, when the market correction started in sort of, 22, we took it upon ourselves to mark down our books by over $500 million. We really took a very conservative approach to how we hold our positions. I will give Eric, my partner, a lot of credit. He's older than I am. He's been through more cycles. I think he has a really sort of disciplined, steady hand, and we think that portfolio actually is going to be a materially better returner than it even looks like today. I would say that two things happened that really drove the strong performance of that portfolio. One was honestly a macro situation in New York. I think it was a really great moment for the New York market where you didn't have as much sort of national attention on New York yet in terms of competition, but you did have a evolved founder group who were starting interesting, diverse businesses. And so I can't give ourselves full credit for all of the performance there, because I do think that to some degree we were in the right time, right place at the right time. That being said, our model is, I think, very sound in that, not unlike Bonfire, the way we construct our portfolios is that any individual position should be able to return the whole fund. If we find a company that ends up being a sort of unicorn $1 billion or $2 billion company, but we're not reliant on these, you now see some of the multi-stage firms that require multiple decacorns to turn the fund once. I think that's really questionable math and hard to drive consistent returns. We think that this $100 to $200 million fund size, where we're taking 40 to 50 core positions with 10% ownership, is going to produce the kind of returns that Fund 5 had on a repeated basis. And in fact, Fund 5, I think, is the only one of our mature funds that, while it does have a $1 billion company, that company is not technically a full fund returner today, while other funds all have a full fund returner. And I think that the reason Fund 5 is so great is that it is an example of depth, not a single outlier. And that's something that's really important to us, is not going to the casino with your money, but building from the ground up really steady returns. And if we end up with a decacorn, we'll deliver everybody 10x and we'll all be very happy, but we don't require that.
Thank you for that. Thank you, Mr. Chair.
Thank you very much. Any additional questions?
Based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $40 million from Lehrer Hippo, Roman numeral 9 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Summer, second from Member Allen. Can we take a roll call vote on the motion?
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
yes,
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative. Motion passes.
Very much.
Thank you all very much. I'm going to make everybody a lot of money.
I like that.
And I have to run to catch an airplane, but really appreciate you having me.
We'll move on to item 2D. Sweetwater.
Sweetwater is a re-up. We're recommending a commitment of up to $75 million to their fourth fund. We invested in their third fund last year in June, which was at the tail end of their last fundraise, which is why they're back within the year. There's a group that focuses on this buying positions in good companies in the secondary market at a discount to fair value. What we're seeing is an increased amount of complexity in the secondary market, where there's opportunities to buy companies in all different types of structures at discounts if you are willing to underwrite individual companies and keep them out. This is a strategy that a couple of our managers are looking to do right now, and we the proliferation of things like continuation vehicles and GP-led kind of solutions to get liquidity in the private equity market. I'll pass it along to the...
Thanks, Mr. Chair. Sweetwater is a re-up for the national program. Another reason why we're bringing it now is there is a first close discount that we want to take advantage of, a 10% management fee discount through the life of the fund. So we'll be able to take advantage of that. Fund 3 is performing well to your previous commitment. It's at a 1.3 times net multiple and a 38% net IRR, but it's still early in that fund life. The Sweetwater primarily focuses on making investments in high-quality companies at below market values, as Chris talked about. I like to view it as they're providing liquidity in an illiquid market and finding ways to do that. And one of the key differentiators of Sweetwater is they're more proactive in their sourcing. You know, they want to look and see what companies they want to own and then find ways to get ownership in those companies. The firm was founded in 2016 by Jim Gammett, who had previous secondary market experience as a partner and head of secondaries at Stepstone. The firm currently has 3 managing partners who lead the firm and average over 20 years of experience. Performance across the firm's first 2 funds has generally been strong to date, and the first 2 funds are tracking above median against the benchmarks. They've also been able to execute several realizations in Fund 2. Some of the fund terms, too, are probably more limited partner friendly than you're used to seeing from a lot of the funds that we bring, because it is a secondary focused fund. We're recommending an up to $75 million commitment to Sweetwater, and Mr. Chair, I'll turn it over to Jim Gammett.
Appreciate the opportunity to see you again. I brought with me Matt Kelsey, another partner. We're now 5 partners at Sweetwater, and maybe a little bit of history combined with our strategy is helpful. I started my career in secondaries in 2004 with a group called Portfolio Advisors. We were doing traditional LP interest secondaries at that shop. We got to about $1 billion deployed. I was hired at mid-level. I was sort of a field captain, but I helped put their policies, procedures, and sourcing efforts together. And when I reached around 2008, a group reached out to me that I had interned with at PCG. They had spun out and formed a new company called Stepstone Group. They said, we've never done secondaries before. We'd love for you to build this business within what we're doing. So I joined them in 2008. I was right when Lehman went out of business. In fact, I think went out of business the day before I closed on my house. I thought, what did I just do? But we ultimately, it was a great time to start a secondaries business because for the next year and a half, there's no liquidity in the market. You can name your price, and it became a buyer's market. And I realized that the traditional market, within about a year and a half of that, when TARP got put in place, got back to par. And I realized buying beta at par was not attractive. And that traditional market became very unattractive because there was just so many assets trying to get through an aperture, a very small aperture. And what we decided to do was do much more focused sourcing efforts. And so when I was there at Stepstone, we actually did one of the first GP lift outs where we bought 10 assets out of a family office. We got to hand select those, and we lifted those out. We ended up getting a 5X on that deal. And I felt passionately that the way to win in the secondary market is to be selective on assets. So fast forward, I left Stepstone in 2013 to form Sweetwater with the idea that what we needed was a direct investment team, like a primary investment team that underwrites at the company level, not at the GP fund level, and that we could seek out individual assets and build our own portfolio. Matt Kelsey was hire number 1 and joined us. We ended up getting a mandate during my garden leave to help the state of Texas work out a portfolio of about 100 venture assets. And through that experience, we brought on our 2 other partners as consultants. So Greg Parise was the head of institutional sales at Hambrick & Quist. When that got sold off, he started running tech companies. So we brought him on to help advise us in winding down that portfolio. We did that for a couple of years and really honed in this strategy as a brand new strategy of finding assets in the secondary market from other institutions, so GPs. So like the 2 gentlemen that were here before, when they get to year 10 or 11 or 12 and they have that $1 billion investment, but that company wants to go to $10 billion and they don't want to wait for that, we come in, we'll offer them liquidity. We offer a big discount because they're not willing to wait. They're funded at the end of life. They're somewhat stressed. And right now we're seeing stress like you've never seen before in the GP market. GPs can't get liquidity. They're down 80% on their distributions. They don't know how to drive distributions. The multiples right now, because interest rates are high, are lower than they've ever seen. They don't want to exit right now in this environment. So we've become a prime candidate to take out that capital. We've seen secondary firms go from 4% of the liquidity in the market up to 20% now of the liquidity in the market. So, like Richard says, it really is about liquidity. And the secondary players, we take advantage of that stress. A lot of it is organizational stress and structural stress, not about the fundamental companies. So we target strong performing companies that happen to be in a portfolio or a structure that is stressed. And we try to press prices down to where we feel like we're getting a great price on a great asset. With that, I guess we can open it for questions.
Absolutely. Okay, thank you very much. Any questions from the council related to the Sweetwater operation? I did have one question for you. So the situation you described of a GP with a nice asset, so could you talk about sort of what you're providing to them that just running a traditional sale process wouldn't provide? Because, you know, in theory, if they wanted to maximize value, they could just hire a banker, run a process, and that's that, right?
So there's two types of sellers in your example. One is someone who owns the cap table, like a buyout manager, and they can run a process, and a minority investor like these individuals here, and they only own 5, 10, 15% of a company, and they cannot drive that process. In the cases where they cannot drive the process, they have no real options except that to get liquidity. In the case where they do control the cap table, they might select, it depends on the quality of the asset. We don't want poor quality assets, so we won't we don't really engage in solutions unless it's a high quality asset. And in that case, they generally want to keep that asset in-house. So that's where the continuation vehicles come into play. They'll either roll it into a new fund, and they'll need an independent group like us to price that out. Or we will give them a strip sell where we will buy 20, 30% of their position. So they can get some DPI, get their LPs to re-up in a new fund, and validate the mark of that asset, but they won't sell the whole thing. So those are different options. We view ourselves as a liquidity solution provider to GPs, and we give them 3 or 4 different options. And depending on their stress level and what kind of situation they're in, they can select different options we provide them. But this fund is going to be 40% direct asset purchases, 30% structure. So one example of the structure would be they would like to hold on to the asset, but they need $30 million of distributions to satisfy some LP demand. We'll come and give them $30 million, but we'll demand a 2x pref on the sale of that asset when it gets sold. So we'll get about $100 million of security backing our $30 million. We are well protected. We get our 2x first, and we participate on the upside. We generally underwrite the 2.5x on our deals, but we like a 2x pref if we do a structure deal. That will be 30% that. We have 20% for CVs and 10% for LP interest, which tend to be tender offers, and we like more concentrated positions if we're going to do a tender offer.
Good. Thank you very much. That's very helpful. Any additional questions?
Chairman.
Commissioner Montoya?
Just a quick question on your previous funds that you've done. What was the total net IRR after completion?
Yeah, pull it up. So on Fund 2, which date do you have?
Page 138, Madam Treasurer, has the track record for their Fund 2 and Fund 3.
Okay, I got it. And then the only other question I had, or just something to point out to council or to staff, is it sounds like this one is a little bit longer rooted before you get to your return that you're looking at, and there's management fee offsets. So both of those things definitely need to be considered as factors in this particular relationship. Thank you, Chairman.
So we target 2 to 4 year exits. That being said, in this environment, the duration is getting stretched to 3 to 5 years. So our duration is we predict to be half that of a growth fund or half that of a lower mid-market buyout group. That's what we're targeting, cutting that duration in half. And then when it comes to management fee offsets, are you referring to our GP stake? And waiving the GP stake. So we do waive management fees for up to 80% of our GP stake. So we do put 20% of our own capital into the GP.
Thank you, Chairman.
Very much. Any additional questions? Is there a motion?
Mr. Chairman, based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RBK, I move that the State Investment Council approve a commitment of up to $75 million to Sweetwater Secondary Fund 4, LP, subject to the contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Second.
Motion by Member Sanchez, second by Member Allen. Could we take a roll call vote on the motion, please?
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
yes,
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
7 in the affirmative, motion passes.
Thank you very much.
Wonderful. We appreciate your support.
Thank you. Okay, now on to item 2E in the New Mexico program. 3E, excuse me.
So, we're recommending a commitment of up to $80 million across 3 different funds and be managed by a group called Up Partners. Up invests in companies that use differentiated technology to make mobility and transportation clean, safe, resilient, and efficient. As part of this commitment, Up will set up a physical location in Albuquerque. We'll co-locate 2 different programs. One is a post-accelerator program focused on climate tech startups called Up Abundance, modeled after a couple other similar programs across the country. One in Chattanooga, Tennessee called Brickyard, and another one called 42 North in Buffalo that have similar models. And then the second thing being a corporate venture lab that they're going to call Up Labs New Mexico, that will build companies focused on solving large industrial challenges identified through its work with its corporate partners. The Up Labs New Mexico team will work initially with a corporate partner to be identified interested in solving climate-related challenges. That corporate partner will make a sizable investment to fund the team as well as the overhead to build 2 startups per year. Our main goal when we changed the strategy for the New Mexico program in 2019 was to increase entrepreneurial activity and the number of companies in the New Mexico program. Assuming the approval of these investments, the New Mexico program will have a wide variety of company creation engines, including venture studios, venture labs, and post-accelerator programs like Up Abundance and last month's Ambo New Mexico, as well as a wide variety of early-stage capital available to founders. And I would suggest if you look at page 168, there's a table with all of the different things that the council has approved, description of all the differences between the different types of strategies and funds, including the Up funds. I'll pass it along to Richard to discuss some more.
Thank you, Mr. Chair. Yeah, I mean, regarding that table too, I mean, we've been talking a lot about, with the New Mexico program, trying to find ways to create new companies, help entrepreneurs be in a situation where they can develop a successful company to really attract that later stage capital into the state. And this commitment is one of those ways that we're hoping to do that, and benefit the state of New Mexico. Up Partners was founded in 2020 by Ben Marcus and Cyrus Sagari, who work together in the aviation industry. They've also added Adam Grosser as a co-founder and managing partner, and he brings 20 years of venture capital experience, including well-known firms like Silver Lake. They launched the Up Labs platform in 2022, which, as Chris mentioned, is a venture lab that partners with corporations to launch startups. So it's a pretty unique way to run these venture labs. They've also put together a group of senior advisors and venture partners to assist with a lot of the consulting that's needed with venture capital companies. And, you know, across these three funds, there is potential for New Mexico investments in each of them. Up Abundance is entirely New Mexico focused, both companies that are located in the state and then also recruiting companies to the state with investments. And this fund's actually going to be led by 2 New Mexico residents who have startup and venture experience. Brian Adams is here, the managing partner at Up, who leads that. Up Labs 1 is that the lab that will focus on climate tech and will be based in New Mexico and have a physical presence. And then Up Ventures 2 is an early stage venture capital fund that can co-invest in these deals as they mature. From a track record perspective, I mean, it is limited because the firm was founded in 2020 and the first fund's still early. But we did look at the prior track record of the 3 managing partners and found several successful investments in that track record. Fund terms are generally average compared to other funds that we see in the market. So we're recommending up to $34 million to Up Ventures 2, $26 million to Up Labs 1, and $20 million to Up Abundance 1. And Mr. Chair, I'll turn it over to Ben Marcus from Brian Adams.
Yeah, let Brian, if you were first. Thank you.
Good morning, Mr. Chair, members of the council. My name is Brian Adams. I'm joined today with Ben Marcus, co-founder and managing partner of Up Partners, and David Ellman, my co-founder here based in Albuquerque at Up Abundance. I'm what you call a New Mexico boomerang. In 2004, I started my career alongside Ben and Cyrus, the founders of Up in Albuquerque. Right after we all graduated from Purdue University together, we all moved to Albuquerque in 2004 for our first jobs. I moved to Seattle in 2009, where I was fortunate to join 2 early-stage startups that were acquired. I also had the privilege of running portfolio development and Amazon's first accelerator program for Amazon's very first corporate venture capital up in Seattle. But it was my connection to Albuquerque, where my wife was born and raised, that ultimately brought my family back here about 3 years ago after our first son was born. Since returning, we've been very proud to call this beautiful state home. Upon moving back, I spent a lot of time connecting with founders, investors, and innovators in our community and beyond the state. It became clear that New Mexico had an extraordinary opportunity to become a great hub for startups and innovation. A big part of that is due to the efforts by the SIC's New Mexico Private Equity Program, which has helped create a powerful pool of capital that's attracted some of the top venture capital firms in the world who are very eager to support companies and invest in those companies that are based in New Mexico. Now we're focused on something that will change the game for our state, attracting climate-focused startups to call New Mexico home. Over the past year, David and I have worked closely with the team at Up to develop these 2 new exciting programs that Richard spoke to, that we're proposing today that we believe will put New Mexico at the forefront of climate tech and startup creation. I'm going to turn it over to Ben, who will share more about Up Partners' strategy and our plans for New Mexico.
Thank you, Brian, and thank you, Mr. Chair, members of the council. It's wonderful to be here with you today. Thanks for the opportunity. We're excited about the potential of the partnership and the transformative impact that we can have on New Mexico's economy, innovation ecosystem, and climate leadership. At Up Partners, we have a clear mission, which is to transform the moving world. Yes, our job is to generate great returns for our limited partners, and that's what we wake up every morning thinking about. But the mission that drives us is how do we make transportation cleaner, faster, safer, and more economical for more people around the world. Transportation has an incredible ability to transform lives. It creates opportunity by connecting people with jobs, education, and healthcare. It unlocks access to global marketplaces, enabling economic growth and prosperity. It improves quality of life by reducing barriers that separate communities. And perhaps most importantly, transportation brings people together, giving people the opportunity to learn from each other, brings diverse people together to find peaceful opportunities to work together. Yet transportation is also one of the largest contributors of greenhouse gas emissions. So if we want to improve the utility of transportation while reducing its climate impact, we have to make bold investments in innovation. This is where Up Partners comes in. Through our venture funds, including Up Abundance and our venture lab, Up Labs, we identify and empower entrepreneurs working on breakthrough climate and mobility solutions. Together, we are reimagining the movement of people and goods, creating a better future, balancing opportunity and sustainability.
We're thrilled by the opportunity to partner with the SIC and to further enhance New Mexico's innovation economy. The Up Abundance strategy is designed to attract climate technology entrepreneurs to New Mexico. In addition, through our proven Up Labs venture building model, we will establish an outpost here in the state, working to build new startups with our corporate partners. Together, this ecosystem creates a lower risk profile for early-stage companies, reducing the randomness of success, bringing talent, bringing technology partners, bringing customers to the table to help enhance outcomes. In closing, we're not only investing in technologies or startups, we're investing in a vision of the future, a future where transportation not only connects us, but also does so sustainably, equitably, and efficiently. We're honored by the opportunity to work with you and build a partnership for the future of New Mexico. Thank you so much for your time, and happy to answer any questions.
Thank you very much. Any questions related to the Up Ventures opportunity?
Question. The concept is getting corporations to work with these labs. We don't have that many corporations in New Mexico. So are you looking at outside corporations investing in New Mexico, or are you talking to E&M or the few that we have here?
Yeah, so we work with corporations from all over the world. Our first corporate partner was Porsche, based in Stuttgart, Germany, but our team that works with Porsche is based in Los Angeles. Our second corporate partner is Alaska Airlines, which is a Seattle-based company. Our team that works with them is based in Silicon Valley. So we'll partner with a corporation that's from outside the state of New Mexico, work together with a team in New Mexico to build startups that are solving the pressing challenges being faced by that corporate partner and their peers in their industry.
One other question.
Sure.
Cybersecurity. Are you investing in any tech related, cybersecurity, AI related?
We have quite a few companies in our portfolio that leverage artificial intelligence to deliver their products and services. Cybersecurity, we haven't yet made a direct investment in the cybersecurity company, but many of the technology companies that are in our portfolio touch on cybersecurity in one way or another.
Very much. One question. Barriers do you see to investing in?
Well, I think the key thing and the reason why Brian and David have been working so hard on thinking this through is talent. How do we attract talented entrepreneurs to the state? Precisely what we're going to be doing with Up Abundance.
Yeah, I think the model we've seen from two successful programs that Chris mentioned, Brickyard in Chattanooga, Tennessee. You don't think of Chattanooga as a tech hub. They get 12,000 applications a year to their program of post-accelerator companies that are interested in going and moving to Chattanooga because they positioned this program a way to get away from the noise of the coast, focus on building and getting to some specific milestone that they've agreed on. So we think there's massive opportunity here, especially with the density that this program's created with Antler last month, Rover Venture Studios 2 years ago, having a density of programs. So when a founder in Portland, Maine looks up, should I build my company in Albuquerque, they see other founders building their companies in New Mexico, they see other programs, and they see $700 million of New Mexico private equity that's been deployed to top venture capital firms that are eager to invest in companies that are based here. We see all of these things as tailwinds for why founders and companies would want to move here and build. And specifically, a lot of the work the state's doing in climate, we're #1 potential for clean energy production in the world. And every single week, every other week, we see announcements about clean energy production projects that are happening in our state. We think these will make great partners, in addition to a lot of the corporations that are already here, potential partners and customers for these companies to work with. So we think they'll move here not only for the capital, but for the opportunity to work with projects, clean energy projects, and corporations that are based here, because startups really need customers more than anything. And we really see that clean energy economy as being, the state is doing an incredible job of building that, and we want to serve those customers with startups, and we've started outreach to some of those people, and we're very eager to learn of the companies we plan to bring in.
Thank you. Any additional questions?
Chairman, I just have one question. On the UP Abundance, the target fund size is 20 million, but SIC is going to be the only client at 20 million. Is that correct?
Correct.
It's an interesting concept. Can you give me a little bit more information as to why we would be the only ones to invest the whole full 20 million in that, or what that is more detailed about?
So the way we're thinking about situations like this, where there's a New Mexico related fund where the reality is I think we need to be the anchor investor because it's New Mexico specific and we want to attract founders to be New Mexico. The way we've sized it, if you look at page 169, we're trying to keep the 20, cap the total aggregate commitment at 20% of the entire fundraise, including Up Abundance, Up Labs, and Up Ventures. We think that's the right balance in terms of partnering with folks who can raise other outside capital. I think we're recognizing that there's certain situations where there needs to be some type of fund of one or SMA that's New Mexico specific to really kind of create the kind of early stage entrepreneurial kind of push that we need to create more companies and more entrepreneurship in this program.
So, Mr. Chairman and Mr. Cassidy, on that million, it clarifies that there's 1 million in climate tech startup in New Mexico. What's the other 19 million going to be utilized for?
It's up to $1 million per 19 startups.
Oh, I got it. Okay, thank you. And then I guess on a technical question, for this motion, are we making the motion for all three items, but for the record to reflect them independently? Or are we doing each one separately?
That's a good question. I defer to our legal counsel.
I would suggest we can say the motion for all of them, but and let the record reflect each one of the motions independently unless there's any controversy on any one of the three that any council member would like to pull out.
So thank you for that suggestion.
It's fine, you just need 4 yeses.
Understood. Any additional questions?
Chairman, based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve the following commitments not to exceed $20 million to Up Abundance Fund 1, LP, $20 million to Up Labs Fund 1, LP, and $34 million to Up Ventures 2, LP. These commitments are subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policy, negotiation of final terms and conditions, and completion of appropriate paperwork. Let the motion reflect individually voted.
Mr. Chair, one comment on the motion. Yep.
I think it's even 26 million to U.S. Fund 1, you said 20, and
Sorry, my mistake.
Just clarify that.
26 million.
Understood. Okay, thank you for that motion. Is there a second?
Second.
Okay, motion from Member Sanchez, second from Member Allen. We take a roll call vote on that motion.
Treasurer Lauren Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
yes,
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
7 in the affirmative, motion passes.
Very much.
Thank you. Thank you. Thank you for your support.
Okay, we are moving on to our real assets investment items, starting with 3F, Oak Tree Power Opportunities Fund 7.
All right, Mr. Chair, we'll do our best to keep with the accelerated cadence we've seen so far today. The presentation materials begin on page 217 of the board book. I have with me Amy Ridge as usual, and from the GP, Michael Chambers and Jimmy Lee. We're here to recommend a $200 million recommendation for commitment to Oak Tree Power Opportunities Fund 7. This particular fund series will be a new relationship for the real assets portfolio. I should also note, however, that SIC does have exposure on the real estate sleeve to Oaktree as well. The treasurer had asked last time at the SIC meeting about those exposures. That amounts to $1.2 billion on a committed basis and around $700 million on NAV basis. In both cases, less than 2% of the aggregate SIC portfolio. Keeping the strategy description brief, Oaktree runs a pick and shovel mid-market focused strategy that tries to provide products and services that debottleneck critical bottlenecks along the energy value chain. We view this as a diversifying exposure for the real assets portfolio and the larger SIC portfolio, particularly because of that debottlenecking focus, which contrasts with the generation focused exposures that we have had across the portfolio more generally. One of the key things, in addition to a really strong track record, that we should like about this fund series is its prior emphasis on New Mexico. I'd mentioned that the fund series has had ownership positions in Array Technologies, Year Out Energy Services. There are a number of other portfolio companies that operate in New Mexico, despite the fact that they're not headquartered here. With that, I think I'll hand off to Amy.
Great, thank you, Keith. Thank you, Mr. Chair. So we are looking at Oaktree Power Opportunities Fund 7. This would fit into the energy portion of your real asset portfolio, and we are recommending up to a $200 million commitment. We've been watching, at Mercer, we've been watching Oaktree Power Opportunities develop over numerous years. They actually were originally founded in 1999 as an independent firm. About 10 years later, in 2009, Oaktree acquired them, and they've been operating as part of the Oaktree platform for about 15 years. And so they've been building the team up in a really thoughtful way. They have achieved really strong success over their track record. And we do like this, Keith and I spent a lot of time thinking about this from just an overall diversification standpoint within the real assets program. You find a lot of infrastructure assets within the program today. We thought this was a really good diversifier and value addition because it's focused on the ancillary services and products that the infrastructure assets and companies need in order to be successful. And so we liked that part coming in. The senior team's been together a very long time, and they've grown to 23 investment professionals today. There are a few things I wanted to point out that we spent some additional time on in due diligence. They did have one of their original founders transition just this year to a senior advisor role. This was actually done in a very thoughtful way. We wish all firms actually did a multi-year process like they did. They originally had started thinking about this in 2017. They started implementing a multi-year transition in 2021. And that professional will continue to be a senior advisor, so still available to the firm. But we think that they've actually handled their succession in a very thoughtful way. So we got comfortable there. The other thing is Brookfield did buy a majority stake in Oaktree in 2019. So we've been watching that over the past 5 years. Oaktree has continued to be able to operate in an independent fashion. We spend a lot of time with the Oaktree Power team. There has not been any changes or concerns in the governance or the investment process, and so we also were able to get comfortable with that. The fund terms are generally in line with market. They actually have a few terms that are more LP friendly, so we like to see that. And finally, track record, which is on page 234 of our materials. You'll see overall the fund series 25-year track record has performed very well, and we think would be additive to your real assets portfolio. So I will turn over Jimmy Lee. He's one of the 3 senior-most members that will be running this fund, and Michael Chambers, who's a managing partner on the investor relations.
Thank you all for your time. Thanks for an excellent summary there. Jimmy and I are pleased to be here and visit with you today. And on behalf of Oaktree, I want to thank you for the partnership that we've established already. Keith had alluded to on the real estate side, as well as we work with you on our opportunistic credit side. And I think you're very much in line with some of our larger clients, not only throughout the United States, but in non-U.S. sovereign wealth funds as well, that have sought to partner with us across the various strengths that we have from a firm perspective. On page 241 of the materials, there's you can see just kind of a breakdown from a firm perspective, and I know you know us from the past discussions, but certainly, happy to answer any questions there around, from a firm perspective. But if not, I'm going to turn it over to Jimmy and let him speak specifically around the Power Opportunity Strategy.
Yeah, thanks, Mike. Thanks, Amy and Keith as well, and thank you for your consideration and time today. As Amy mentioned, I'm one of the 3 portfolio managers of the strategy. My entire investing career has been with the Power Opportunities team since I joined back in 2009. And prior to that, I spent several years as both an operator and an M&A advisor with Merrill Lynch and Honeywell, both in the end markets that we invest in today. Our history actually dates back to the 80s. I think it's important to spend some time just elaborating on what Amy mentioned because it sets the tone and the context for what we still do today. So our founders were actually utility consultants back in the 80s, advising their clients, utility customers with regulation at the time. They sold their practice in the late 80s to Arthur Andersen, headed up their worldwide utility consulting practice for a few years. After doing that, they said, hey, I want to do something else, not as fun working for a large bureaucratic accounting firm. One of the ideas that they had was, we have this great insight, great intel from our utility clients. We know exactly where they spend money. We know exactly what the challenges and opportunities are. Why don't we take that insight and information and become direct investors in the utility infrastructure landscape? So that's how we got started in the mid-90s. At the time, they're very good at coming up with various investment themes impacting the core value chains of utility infrastructure. Very good at originating new transactions, but obviously didn't have the capital to transact. One of the early partners that they teamed up with at the time was Oaktree Capital. That's how the partnership and the relationship with Oaktree got started over 30 years ago. Our first 2 funds were in the form of a dedicated 50-50 general partnership with Oaktree, starting with Fund 3. As Amy mentioned, in 2009, Oaktree effectively changed the name on the door, and our group and our strategy became a dedicated strategy within Oaktree Capital. So we've been doing the exact same thing over the past 30 years. It's a focus on investing in companies that provide the picks and shovels, the products and service companies, to the utility critical infrastructure. Our primary end market, our primary value chain is the power value chain, although we do spend some time in other adjacent end markets, including energy and other utility applications as well. Our origination approach really starts and ends with our core investment case. And I think this is what's unique about our strategy as well. If you're to go back 30 years and take a look at our very first private placement memorandum, you'll see mention of the exact same investment themes that we're investing behind today in Fund 7. Our 3 most pervasive investment themes across all of our investments is 1, aging infrastructure, 2 is energy efficiency, and 3rd is a long-term secular tailwind of renewable capacity additions. So across all of our investments, I believe you can bucket each and every one across those 3 investments. And over the past 30 years, what's also interesting to note is we've been investing in a climate where there's been virtually no power demand load growth. Even though power consumption has increased, it's been largely offset by greater energy efficiency technologies. Now, for the first time, going back a couple of years and expected to continue for the next couple of decades, we're talking about investing in an environment where for the first time there's going to be 4, 5, 6% compounded annual growth with respect to power demand and load growth going forward. That is a significant transformative shift in our industry that we haven't seen before. So our investment activity, our track record has been largely built on the built infrastructure, and now we're talking about for the first time a significant expansion of the infrastructure due to increasing power requirements. Those are all things that I'm sure you've heard of related to the expansion of data centers, especially high power computing data centers, electrification of fleet and building appliances, and also the reshoring and onshoring of manufacturing facilities that we're seeing today. So we expect that to be a significant catalyst going forward, and one that we're excited about with respect to our opportunities. Also, we're looking for companies that fit a specific profile. So our investment approach is really tied to partnership, is relationship-driven with the companies that we target. So these typically are founder-owned businesses, family-owned companies, management teams that have significant equity. And these are long-term relationships that we're driving over many years. In fact, the average length of getting to know a company or the sellers is roughly 7 years before we make an investment. We play the long game with respect to developing these relationships that ultimately lead to proprietary or bilateral transactions. So roughly about 80% of all of our deal flow is truly proprietary in nature, where we're acquiring businesses off-market and outside of a banked auction process. That is absolutely critical to our overall success because it ties into our value creation playbook, which isn't predicated on financial engineering. So we use very low use of leverage when we finance or capitalize our transactions. Roughly about 2 times debt to EBITDA across all of our realized investments. These are companies that can take on 4, 5, 6 times plus, but we tend to be very prudent, very disciplined,
We're very much focused on finding companies where we can deploy our value creation playbook, which is both focused on internal improvements and external growth. On the internal side, as you may imagine, being the first institutional partner, there's a lot of opportunities to professionalize these businesses with respect to the systems, the processes, the controls, the augmentation of the management teams and governance. And externally, just given our 30 years of history, investing in the same sectors, developing relationships with like-minded companies and customers and vendors, we're able to accelerate the growth by making introductions, tangible introductions to utility customers in many cases, or bringing to bear acquisition targets that we think can help accelerate the value creation plan. So for Fund 7, we expect to make roughly about 13 to 15 platform investments. These are typically control investments. In some cases, we'll make minority investments, but those are situations where we have significant influence and governance rights. Again, it's a very value-oriented playbook where we're hands-on, we come in, we're strategic thought partners, we're able to accelerate growth more so than what these companies and resellers have done previously, and that model won't change going forward. Most of our investing will be in the U.S. 80% of our investing activity historically over the past couple of funds is in the U.S., North America. We do have a European team comprised of 7 investment professionals, and we expect they'll represent anywhere between 20 to 25% going forward. So I'll pause there.
Thank you. Any questions from the council?
Mr. Chairman, I do have a couple questions. One was clarification on what was said. Was it 1.2 billion and 700 million or 1.2 million?
That was 1.2 billion and 700 million, right?
That we already currently have invested with Oaktree.
That's a composite of Oaktree and Brookfield, based on the Brookfield acquisition of Oaktree.
Okay, and Mr. Chairman, my first question is actually about Brookfield. One of the cons that was mentioned in the report mentioned that specific issue. So if you could go in a little bit more detail for me on both the Brookfield ownership as well as your own folks not really investing in this one. So I'd start there.
Yeah, so starting with the Brookfield relationship, as mentioned by Amy, Brookfield acquired an economic majority interest in Oaktree back in 2019, but they actually don't have control of Oaktree so long as our founders and principals still own their equity stake, which they still do today. So they treated Oaktree as an arm's length partner. We're an independent firm from Brookfield. In fact, it's actually harder to work with Brookfield because it has to go through some compliance and legal hoops and considerations, and Brookfield has stated definitively that they expect to operate in this environment definitively and going forward, irrespective of the ownership interest of the Oaktree principals and founders. So we tend to be further removed from broader Oaktree, just given the genesis of our history and what we do. Even inside of Oaktree, we represent about $4 billion of total AUM within the equities asset class. But given our history and our genesis and Oaktree's predominant focus on credit and real assets, we tend to be typically a little bit different in terms of our focus and strategy with respect to broader Oaktree. So for example, our physical location is actually separate and independent from Oaktree. It only is comprised of our team. Our decision-making, most importantly, is unique to our team and our strategy, so we have no other Oaktree representatives. Every now and then, if the situation makes sense, we'll co-invest with other Oaktree strategies. In those instances, we're the ones in control and we're the ones driving the decision-making. There's been few and far between. I think we've only had 4 investments where we've co-invested with other Oaktree strategies on our platform investments. Those are situations where we're investing in the same security to avoid or minimize any potential conflicts.
Okay, and Mr. Chairman, I didn't catch the name of the presenter. Did you guys say it was Jason Lee?
No, it's Jimmy Lee. Jimmy Lee.
Is there a relation?
There's not a relation to Jason Lee. Jason Lee was a former team member of ours. He actually left the firm in 2021 after COVID. He actually retired during that time period. Unfortunately, he had a significant bout with COVID, and he's been retired since and is spending more of his time teaching and advising companies in our sectors.
So, Mr. Lee, the reason why I bring that up is I'm looking at the senior level departure, and out of all 5, 3 of them have left. So can you give me a little bit of understanding of that aspect of it?
Yeah, no, it's a fair question. So Michael Cardita, who's one of our portfolio managers and the leader of our strategy, he's been with the team over a decade. And, Michael was actually appointed as the co-PM starting with Fund 5 back in 2017, as Amy mentioned. And subsequently, he succeeded our founder, Ian Shapiro, as the sole portfolio manager going back to Fund 6. So from a leadership standpoint, he's been the one that's been overseeing our group really over the past couple of funds. As Amy mentioned, one of our founders, Ian Shapiro, has been actively involved over the past couple of funds, but he wasn't a key man, he wasn't a key principal, he wasn't responsible for originating any deals. So he acted in the capacity of a senior advisor and effectively announced his full retirement from Oaktree earlier this year. But that succession plan has been very thoughtful. In fact, we like to joke that he's probably retired 3 or 4 times since he's announced his initial transition. And looking back on it, I think he did it the right way, and he did it very thoughtfully to ensure a successful succession to Michael and the current leadership team in place today. So the portfolio managers, including myself and Francesco, have been the key principals really going back to Fund 5 and starting in Fund 6, especially after Jason Lee's departure in 2021. The other senior level team members, Andrew Adler, he actually is a vice president. He was responsible for predominantly business development and origination. He decided to pursue other opportunities. We mentioned Jason Lee's retirement, and also Andrew Osler retired several years ago, but is still an active senior advisor on our team and is active with our investment committee and group discussions on both new investments and strategic portfolio.
Thank you for that clear response. I do have a question regarding, because there's so much shift and change within your organization. There was a comment made that it would be preferable to see a minimum commitment from the investment team to become mandatory to mitigate risk of a low level of personal investment. For me, putting skin in the game along with another partner is important because there's such a shift in change. If you could put yourself in my shoes for a second, we have over 1.9 billion already with you all out of 58 billion dollars that the full portfolio has. And you have a lot of shift of change in both leadership and within the switch off to Oaktree. And you don't have a lot of people that are actually invested within your own organization. So if you're me, what would be your thoughts on that?
Madam Treasurer, this is Director Sable. I wanted to make one quick correction of the record. The 1.2 billion is the market value on a committed basis rather, and the 700 million at market value. Those are just different ways of looking at the same asset, but there's not actually a 1.9 billion total. The largest total, I guess, would be the 1.7. Still a large number, certainly, but not 1.9.
Thank you for the clarification.
So is it fair to say we have 700 million invested and our total commitment, including that, is 1.2?
Correct.
Or out of 1.2 billion that we've authorized them to have, 700 million has been invested. Is that what you're saying?
Correct.
Okay, so it's a total of 1.2 that's already been. Thank you for correcting that or clarifying that.
And Madam Treasurer, if I may answer the question that you raised with respect to the team's personal commitment, let me just preface this by saying the existing leadership team and the team that we currently have in place has significant runway going forward. The 3 leaders that I mentioned before, these are individuals that have been solely responsible for the deployment and the oversight over the past several funds now, and that team has significant runway going forward. So this is a team that we're very confident will continue to deliver the successful track record and the investment results that the institution has seen many times over. And I think it's been a hallmark of our group's success in terms of the transition plan, institutionalizing what we do, and what makes us different within our sector focus and also our strategy. So that will continue from my perspective. You're correct, there is no specific requirement for individuals to invest in Oaktree GP funds. That said, I will personally be putting up a significant amount of my net worth into this fund, as well as Michael Cardino and Francesco Giuliani. So it will be a significant 7-figure investment. We do have the confidence of the broader Oaktree team as well, so we have the best performing strategy across all of Oaktree. A lot of employees, both internal to our team and external across all of Oaktree, will be making significant investments in Fund 7 and going forward.
Okay. Another question for you. I really do appreciate that. I would almost wish that we could see that action happen first before adding more money to Oak Tree. But there's a subject matter of co-investment. And I do notice that you have some co-investments that are permissible with some of the LPs. I was just curious, I don't know if this is a staff question or for Mr. Lee, but was there a consideration of doing a co-investment? Have we done, is any of the 1.2 billion part of co-investments? Or what was the thought process on the aspect of doing a co-investment program with them?
This is Director Sable speaking. We have, as a matter of routine, tried to develop co-investment programs with many of our managers. In many circumstances, those are very much larger strategies where there's an opportunity to get a pretty broad portfolio exposure within that co-investment vehicle. This is a somewhat more concentrated strategy, and it is the first commitment to this fund series. And so we thought, discretion being the better part of valor, that this particular vintage, we would opt not to do that. But assuming that the relationship develops as we would expect over time, that would certainly be on the table for subsequent vintages.
Okay, and last question, Mr. Chairman. You have a great success rate on net IRR in the past, and there was some part of the paperwork that mentioned the volatility where some have done really good, some have not done so great. Predecessor funds have a high loss ratio based on the number of investments. The high variance in ratio and loss is notable. I guess, to be fair, my question would be, what are some of the lessons learned that you'll utilize within this new fund?
Yeah, no, great question. I think the lessons learned also started going back to our experience with Fund 3 and the predecessor funds before Fund 3 as well. So starting with Fund 4, which is a 2015-2016 vintage, we took a look at our results in Fund 3. It was a good fund, not a great fund. I think it met our general target returns. But we realized that we fell short in terms of our own expectations. And the two primary lessons learned that we spent a lot of time thinking about in terms of what we can do going forward to change. One is staying consistent with respect to deal sizes and size of companies. So when you take a look at the predecessor funds, Funds 1 through 3, we made a number of smaller investments. Naturally, those smaller investments had greater risk associated with those companies. And we used to be somewhat size agnostic so long as the profit potential was relevant, appropriate, or commensurate with the size of the fund. And quickly realized, taking a look at the track record of those three funds, the smaller investments took more time. We're also very lean. We had 8 investment professionals when I joined in 2009, and we're up to 25 plus, both in the U.S. and in Europe. So those are the two primary changes, starting with Fund 4, is consistency, less volatility, dispersion with respect to the size of companies that we invest in at start. And then second, making sure that we have the appropriate resources and capabilities amongst the team to properly deploy a fund size of $1 billion plus. I think you really see the results of that. Of course, Fund 4 was an extraordinary fund. That's not the target return that any of us should expect going forward. But I think in large part it was a byproduct of the changes that we made, both to invest in the resources of the team and also to stay consistent with the size of companies. So we expect Fund 5 and Fund 6 to be well within our target returns. Both are off to a terrific start, even though they're still relatively early. Fund 5 is a $1.4 billion fund, 2019 vintage. So the investment period just expired early this year. We're in value creation mode, but we're off to a good start with monetizations. We've roughly distributed 75% of our invested capital across 4 platform investments and still have 8 remaining platform investments where we're creating significant value. And Fund 6 is a 2022 vintage, which is about $2 billion, and very consistent with what we accomplished in Fund 5 with respect to size, scale, and diversification of the businesses within that portfolio, but obviously relatively early in the fund vintage.
Thank you. I think this last question for the director would be, if we have 700 million, but out of 1.2 billion allocated, why exactly are we adding in another 200 million? I mean, I know it's in a different asset class in total, but did we consider maybe putting that?
There's a number of different moving parts in this. Some of the allocated number, if you will, was related to older funds, some of which have distributed significant capital at this point. And so some of that's not necessarily waiting to be called, some of it's already been returned, but the addition that Mikhail performed for me out of the risks was accumulating just on a committed basis. I think the committed not called value I don't have with me, but is certainly lower than that value. And the other challenge is we don't actually control across any of the private market strategies when the capital is actually called. That's predominantly driven by prevailing market circumstances. And so the best that we can do as asset class directors is to identify attractive investment opportunities and make sure we get those before the SIC in a timely manner so that capital can be called when the circumstances would dictate.
Okay, and I just have one last question for Mr. Lee. I'm looking at your page 245, 246, and your conversation about DEI, future leadership programs, educational tracks. Your DEI doesn't look very DEI right now, and you're basically looking at potentially 1.5 billion out of 50, 55, 57 billion dollars in New Mexico, which is a majority minority population. Can you just give me some insight on how you're strengthening your DEI program?
Yeah, no, this is a significant focus of our team and also Oak Tree, broadly speaking, at the GP level. Oak Tree is very committed to their diversity and inclusion policy. We've always facilitated and fostered an environment of being inclusive and also committed to expanding the talent pool from a diversification perspective. And that also is consistent with our commitment going forward. We acknowledge that we're likely behind in terms of where we want to be with respect to diversification representation from underrepresented groups and also females. But with respect to overall diversity, 33% of our investment team is actually diverse or female, but we're actively seeking to increase that number over the course of Fund 7 as well. So we actually received this feedback heading into Fund 6. At that point in time, we had unfortunately 0 female investment professionals. We've hired 3 since. 2 are still with the team. We're quite excited about their retention and development and progress going forward. And this is a firm commitment from the leadership team within the Power Group to increase the representation from diverse groups going forward. Our team members spend a lot of time within Oak Tree's diversity and inclusive programs. Michael Cardito is on the D&I Council globally for Oak Tree. We have several team members that are involved with the various groups that we support both internally and externally with respect to our D&I campaign. So absolutely a focus of ours, and we expect this to improve going forward.
Okay, I would say just looking at your picture, there's 4 women out of 27, and I don't see really any brown people at all, other than maybe 1. So it does concern me, especially as the only Latina in the country's history. I know there's a lot of smart, intelligent people of diversity that could bring some value to your organization. So it's just something else to consider. Thank you, Chairman, for being so kind with your time.
Thank you, Madam Treasurer. Do we have any additional questions related to this opportunity?
May I just point out that this is for Fund 7. There's a typo in the
typo in the motion.
It's 9.
Yeah. We have a motion?
Based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $200 million to Oak Tree Power Opportunity Fund 7, LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, completion of appropriate paperwork.
Second. Motion by Member Allen, second by Member Summer. We take a roll call vote on the motion.
Treasurer Laura Montoya,
I'm gonna pass.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Dingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 6 in the affirmative.
Thank you very much.
You still have to come back to me to vote.
Apologies, Madam Treasurer. Let me
That's my
come
fault.
back to you. Would you like to vote?
Yes, I would like to. And I want to explain my vote.
Please go right ahead.
Mr. Lee, I appreciate all of your kindness in answering the question so thoughtfully. I know that the director did a lot of work on this. I still feel pretty conflicted about this for a number of reasons, but if you could please work on some of those things, and I'll keep an eye out. I'm just gonna give the benefit of the doubt because I really do appreciate the work you guys have done, and it seems like a really great fund to be a part of as far as partnership. So thank you for your guys' time on this one.
Thank you, Madam Treasurer. We won't let you down. Appreciate your time.
Very much.
Thank you.
Thank you.
Okay, we're now on 3G, Copenhagen Infrastructure Partners 5.
Mr. Chair, we're here to recommend a top-up of $137.5 million with Copenhagen Investment Partners. That would be split $100 million to the fund and $37.5 million to a predefined, now predefined co-investment vehicle. This is a top-up, as I mentioned. Copenhagen was first approved here at SIC in September of 23. Copenhagen is arguably the market leader in utility scale development of renewable power projects. One of the things that we like about the opportunity here certainly is it gives us a chance to leverage existing work to get this capital deployed. We've had negotiations with the management team there, and they've richened the ratio of co-investment to main fund dollars, and so we're getting an incremental blend down of fees through pursuing this activity. We've recently obtained a business update from the management team at CIP. The portfolio investments are currently marked at cost, but largely performing according to business plans, and we're expecting a step up in valuations following an imminent final close. One of the other details that was able to be further developed in the interim since last September, the co-investment portfolio has been completely specified at this point. It will cover 11 investments across 3 different strategy types and 3 major geographies, and each of these will be investments in the main fund. I think I'll just pause here and hand it over to Andy.
Yeah, no, I agree. Keith and I had a great update call with them. We've been watching. They've been executing their strategy as they were here in September and told us they would. So we feel comfortable. They've gotten, you'll see on page 284, they have 6 different projects that are already done. It includes some U.S. onshore wind farm, solar development in Europe, battery storage. So again, really executing the strategy that they said. This will be an immediate add in valuation we would expect to your Q1 performance. So it'll be out of the J curve, which is also positive from a returns perspective. And so, yeah, with that, we're comfortable, and this is really just increasing in order to meet the new pacing plan, which Keith and I have been working towards this year.
Do we have any presentations by the management today?
No, consistent with the previous precedent with these meetings, we have had the manager come over from Denmark.
Okay. Are there any questions related to this top-up commitment? Hearing none, do we have a motion?
Based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a top-up commitment of up to $100 million to Copenhagen Investment Partners, BLP, and in addition, a commitment of up to $37.5 million in a related co-investment vehicle, subject to contingent upon New Mexico legal requirements in policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
For a second?
Second.
Motion by member Allen, second by member Sanchez. Will you take a roll call vote on the motion?
Treasurer Laura Montoya,
Yes, sorry about that.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer.
Yes.
7 in the affirmative, motion passes.
Thank you very much. We're now moving on to 3H, FPA Apartment Opportunities Fund 9.
Sorry. Mr. Chair, we're here to recommend a $200 million top-up, or re-up rather, with FPA and the Apartment Opportunities Fund Series 9. This would be our second investment in this fund series. We also have exposures to the firm's Core Plus vintage, which is 2021. To summarize real briefly, the strategy that FPA pursues is opportunistically acquiring poorly capitalized Class B apartments in suburban portions of major markets that are characterized by above-average job and population growth. They seek to deploy modest CapEx to reposition those properties so that they will ultimately be able to drive NOI growth by improving the value proposition of those properties in the market. A couple of things that we find compelling about the strategy. One, we like the small ticket sizes. During the course of the structure study, we identified that smaller managers able to execute on smaller deals at scale have typically generated better performance, and so it's a strong indicator in our view that they should be able to continue to generate strong performance. The managers also maintain discipline with respect to the growth of the size of the overall portfolio. From a performance perspective, 4 or 5 prior vintages have generated above median performance versus peers. 3 have been in the top quartile. The specific vintage prior or preceding this one is still early in the investment stage, and so there's insufficient data to make any strong conclusions about that fund's performance. I guess one of the other elements that I would add that we find compelling about the strategy is it does diversify the real estate footprint versus a fund like Fairfield that had more exposure in the apartment space in the Smile, so West Coast down through the southeast and up the East Coast. Certainly, FPA does have properties there, but a much more broadly diversified footprint by geography. With that, I'll hand off to Rob.
Good morning, everybody. Good to be here. A portfolio comment to begin with. You know, we're trying to build the real estate exposure that you have here. Currently, you're underweight to real estate generally, and your program is growing. So we're in a catch-up mode. We're trying to get to a current allocation plus keep up with the growth of your program. And the second thing is within real estate, we're trying to expand the level of exposure you have to residential strategies. As a firm, we think that that's one of the areas of growth. There's demand for space, and that creates an opportunity to find good investment opportunities. The residential strategies make up 30% of your benchmark, and you know, based on where you're growing to 5 years out, we think you probably need to grow your residential exposure by at least $1 billion, maybe up to $2 billion over the next 5 years, depending on how the market shakes out. We've been in a period where the market has been frozen for a couple of years, and there has been a lot of investment activity, so a lot of the commitments that we've made are waiting to be invested still, even though you've been ramping up your commitment activity going forward. So trying to expand residential within a real estate portfolio that's playing a little bit of a catch-up game. Keith went over most of the highlights here, why we like this strategy.
This particular fund is a differentiated strategy from what you have. Track record is good. The team, FPA has built a solid team around Mr. Fowler and his key executives at the firm. They have about 50 investment professionals, and then a platform of almost 1,500 investment related people that are working at the operational level at individual properties around the country. We also like the fact that it's a vertically integrated firm, so it's very hands-on. They're doing all the operations at the property level. They're doing the investment management. They're organizing all the construction work, all the leverage, everything in-house in one shop, so they don't have to rely on third parties, which usually results in a splitting of profits. What that means when it's vertically integrated like this is basically all the profits are preserved for the investors, as opposed to splitting with a third-party operating partner. There was some discussion at the investment committee, which I'm sure we'll get into. We identified one of the issues here is the key person risk with FPA. Mr. Fowler's here with us today. He's the founder of the firm, one of the firm's founders, and he's the principal owner, and he's the CEO of the firm. So the firm is very much directed by Mr. Fowler's activities. As I said, he did build that platform around him as well. And we think that there are good mitigating factors in place in connection with the key person risk in this particular situation. Beginning with, you've got good, strong contractual provisions. So to the extent that anything should happen to Mr. Fowler, he's incapacitated. The investment process in this fund is automatically ceased, so the firm won't invest any more capital unless the LPs collectively vote to reinstate the investment period. So there's a pause so everybody can check and see what's going on at the firm and determine whether they want to continue. We also think that the alignment of interest that the leadership at FPA has put together is pretty attractive in this platform relative to some of the others. So the investment team is putting in up to $70 million of GP co-investments. They're targeting 4% of total commitments will come from the leadership and the team at FPA. The typical real estate fund is about 2%, so this is twice what the typical fund puts in, and it's a significant amount of money that they are rolling back into the firm. We think that's a great alignment of interest. The other thing is they distribute the profits of the firm very widely. A minimum of 40% of the profits are distributed around the firm and deeply within the firm. I think up to 90 investment professionals are sharing in the promoted interest in this strategy, which we find very compelling. And the fee structure here is a little bit better than standard, if you will, in that the preferred return to you as an investor is 9%. We typically see 7 to 8%, so it's a little bit better, a little bit more money in your pocket before the manager starts sharing in profit with its carried interest. So all of those factors we think create a nice alignment of interest, which again helps mitigate some of the key person risk associated with a firm that's dominated by one investment professional. So I think with that, we'll turn it over to Mr. Fowler and Hannah Moriarty to talk about FPA.
First off, I really appreciate the two investments you've made for us, and they're both doing well, and you were timed well, and that 40% of the assets we recently bought in the last 2 years in both Core Plus 5 and Value at 8 were at a loss to the previous owner of about 30%. So we've been able to really capitalize on all the dislocation in the market. Many people use adjustable rate debt, high leverage, or did construction that didn't hit the yield they thought they would. Interest rates have obviously risen. That's provided an opportunity for us to buy. As far as the succession plan, I think we have it figured out pretty clearly, and I don't think that was fed to you guys in the original meeting, in that when I leave, my shares go to the company, and when anyone leaves, the shares go to the company. So I had two partners, we bought out each of them. When they left, they got a tail on 3 funds, and then they were gone, and then it goes to the managing professionals. So our long-term plan is we have 12 people that are 5 on the current 7 are on the current executive committee, and there's another 5 that are going to be added. So So there's 12 people, they all work for us now. There's no addition of others if something happens to me. My share goes to them, but at the same time, when they leave, their shares go to the next investment professionals. So we really copied, Sequoia Heritage was an investor of ours, the Sequoia offshoot of their endowment fund. And that's really how they do it, is that the investment professionals make the promotes of the team on the bench. The other thing I wanted to say is we're 100% owned by myself and the employees. So we don't have an outside investor. So instead of X percentage of our dollars going back to feed the mothership, it's all there to pay the team. And the other thing is 100 people share in our promote. So we've had very little turnover. Our CIO started as an analyst. He's been with us 21 years. Our CFO is our tax accountant, been with us 20 years. Our controller's been with us 20 years. Anna started as an analyst, has been with us 19 years. Our two top acquisition guys, one started as an analyst. He's been with us 14 years. Other guys been with us 11. Our previous head of management was with us 32 years, and the guy that's replaced him has been in charge 3 years, has been with the firm 7 years. Also started at a college hire. So we've really been able to develop talent and bring people up. And we do have 1,550 employees. So I think a lot of people say it's you, but it's really 1,550 people. And what I've really been good at is hiring good people and then bringing them up to run the firm. But definitely, I have invested in the 8 funds we have going now, myself, over $150 million of equity, no promote. So just like you're worried about what happens if something happens to me, myself and my family are also worried about what happens to me. And the way it works is the current management team, the executive committee takes over, and then they share the profits with the current 100 employees. So the company is owned actually 65% is what we're up to in the promote now. And then on the Core Plus funds, we get 30% of the gross fee, which is about 75 to 80% of profits. Employees. So it is already employee owned, and the team to run the company is already here. So I wanted to answer any questions on that, because I know that was an issue in the early meetings, but I'm here to answer any questions on that.
Thank you for addressing that. Any questions for Mr. Fowler or the team on that topic? Okay. Any questions on any of the other matters related to the opportunity?
Did you want me to do any more on the firm or the presentation? I know you guys are tight for time.
Yeah, I defer to the members. Would anyone like to hear a walkthrough a brief walkthrough of the slide deck? Hearing none, I'll go ahead and make this motion. Based on the recommendation of Advisor Townsend, SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $200 million to FPA Apartment Opportunity Fund 9 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and appropriate paperwork. Okay, motion by the chair, second by member Summer. We have a roll call vote.
Treasurer Laura Montoya.
Yes, and thank you for the clarification and being with us today.
Nick Tejas.
Yes, and I also support the treasurer. Thank you for that explanation. It alleviated a lot of the concern.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
7 in the affirmative, motion passes.
Okay, thank you very much.
Thank you.
Thank you
We're
very
invested
much.
with you. We're gonna make you money. We really appreciate the opportunity.
Thank you.
Thank you.
All right, that moves us to item 3I, private debt opportunity with Berkshire Multifamily Credit Fund 4.
Thank you, Chair Bingaman, members of the council. Just a quick note before I get started here. Sorry.
Aside from Mary Bates, to my left, who's SIC's primary partner at Makita. As the council knows, Makita is a dedicated real estate team. In the past, Reggie Ross has supported the SIC real estate debt market commitments. Our support there has changed to Scott Maynard, with the Makita real estate team. As I mentioned in the CIC, knew Scott's name before he joined Makita, so pretty happy that he joined Makita. So I'm going to go through my talking points, and once I get done with that, we'll turn it over to Mary and Scott. Also want to point out that we have John File and Ed Gates, Jed Gates from Berkshire with us today to answer any questions. So SIC staff, in consultation with Makita, recommends a commitment of up to $150 million to Berkshire Multifamily Credit Fund 4. This is a re-up recommendation from the prior fund, which was BMC 3. So for quick background, in response to losses endured by the Federal Home Loan Mortgage Corporation, Freddie Mac, as a result of the global financial crisis, the Freddie Mac K program was created to improve Freddie Mac's balance sheet risk. Essentially, Freddie Mac began utilizing the Freddie Mac program, or K program, along with other housing agency securitization programs, to allow Freddie Mac to continue its funding of the housing market, multifamily housing market, while maintaining appropriate on-balance sheet risk and alleviating the need for, frankly, future public bailout. The Freddie K program securitizes multifamily loans that were traditionally held pre-GFC on balance sheet at Freddie Mac. They are the underlying loan pools, the loans in the pools, they're comprised of apartment collateral, consisting of stabilized assets written on in-place cash flows. So these aren't bridge loans, they're not construction loans. Frankly, these are the best of the best loans. That's why the program loss rates are so low. It's why Berkshire's loss rates, aside from Berkshire's underwriting capabilities, it's pristine borrowers, pristine assets. BNC4 will focus exclusively on debt opportunities, which will be, and 75 to 90% of it will be comprised of K program loans. Just real quickly, the original Berkshire entities that invested in real estate trace back to the late 60s, mid to late 60s. Accordingly, the manager has a pretty long-standing relationship with Freddie Mac. I think you guys began investing in the program back in 2009 at its inception. SIC has a long history with Berkshire as well. There's a table, I think it's on the second page of your staff memo. Our first commitment started with Berkshire back in 2013. Technically, we've made 6 commitments over the life of our relationship. One has completely paid out. The second one should completely pay out this year. So right now we're sitting on, from a history standpoint, over $300 million total commitments. Got a remaining net asset value of $200 million. When you look at the remaining net asset value plus what's been distributed, you've got about a $100 million difference. As Mary Bates likes to say, that that's the real money been made from our investing with them. So $100 million over about decades, pretty decent. It's going to be a commingled closed-end fund. It's going to have a drawdown capital structure. It will be assigned to the diversifying strategies category, and you're looking at unlevered net returns of net of fees of targeting 10 to 11%, with a net multiple of 1.4 to 1.5 times. Just real quickly, I would say the downside of this strategy, in my personal view, is a little different from a number of credit-oriented strategies that you'll see us bring to the council, in that the downside to this is less about credit losses, and it's more about the fact that the origination may stop. So therefore they may not put as much money to work as we would want to put to work. So if the apartment market shut down, it would more or less, there wouldn't be new loans to necessarily originate. Given the pristine nature of these loans and the underlying collateral, it's less about credit, it's more about just the ability to put money to work over time, which is somewhat out of control. It really depends on Freddie Mac and the market. So with that, I'm going to turn it over to Mary Ann Scott.
Great, thanks so much, Tom. So in the interest of time, I'm not going to say anything, and I'm going to turn it over to Scott and just ask you to focus your comments exclusively, given Tom's overview on kind of the strengths and concerns and mitigants on this commitment.
Yeah, will do. Thanks, Mary and Tom. So I think during our diligence, some of the things that I would highlight just as a merit is Berkshire's platform. They're a residentially focused manager with close to 500,000 units that are owned or managed. And I note this because it provides the credit team with additional perspective on assets that the fund may lend to. And then, as Tom mentioned, Berkshire has a very long-standing relationship with Freddie Mac and has been investing in the K-Series program since its inception in 2009. Another merit here is really just the K-Series program and access to it. The program has some very positive attributes, such as a low loss ratio, and this is partly attributable to strict underwriting standards to qualify for an agency loan, and then also partly attributable to the fact that if a borrower defaults on a loan, it's tough for them to access agency financing in the future. Staying on the merits, I'd say, looking at performance of Berkshire's Fund 1, 2, and 3, performance has been robust, ranking the first and second quartile, and it has notably seen very low loss ratios, which, as I mentioned, is a unique characteristic of the K-Series program. Just highlight two considerations from our diligence. One is the weaker alignment. The GP is only going to be committing about 0.5%. We typically like to see about 1 to 2%. And then sourcing, as Tom mentioned, the reliance on Freddie Mac to generate deal flow. And this has really come into focus over the last 2 years, where we've seen a noticeable pullback in overall transactional volume. With that, I'll hand it over to Berkshire.
Thank you. Thank you, Tom. Thank you, Mary. Thank you, Scott. And thank you to Council for the opportunity to be here today. Really grateful for the chance to present Credit Fund 4 for your consideration. And the SIC relationship is one that's long been really important to us organizationally. As Tom alluded to, this is a strategic partnership that dates back to 2013. We've been really fortunate in having your support across 6 different fund investments with us, totaling over $330 million, inclusive of the predecessor vehicle to the one that's being considered today. Really excited about, about the opportunity to expand on the success that we've enjoyed together. I did think it might be helpful, since it's been a little bit of time since we were in front of Council, just very quickly hit on some organizational updates that complement the data that's already been provided to you. We're entering our 58th year of being a vertically integrated multifamily specialist. They were up to almost 1,000 employees. Importantly, 780 of those are wholly dedicated to the ongoing operations and management of our portfolio, and the remainder being across investments, portfolio management, asset management, research, all the core competencies that you would expect to see in a sophisticated fund manager. Today, we steward almost $29 billion of capital, and the distribution of that capital is about 60% debt and credit, 40% equity. I think the significance of that is that we think being an owner and operator of apartments ourselves allows us to be a more astute lender and evaluator of credit across the multifamily industry. We do take a multifaceted approach to investing in multifamily. So we've got a series, 4 flagship funds. One is credit, which is the focus of today. One is a direct lending program. One a value add fund series, not dissimilar to what Mr. Fowler was just describing they do in their platform. And then the 4th, an open-end core fund. We've been really fortunate that SIC has elected to support us across all 4 of those flagship fund series. Today, we currently, as reference, own, operate, and oversee almost 500,000 units across 48 states. Really happy to be able to say that
23 of those loans, or about $340 million, is located here in New Mexico within our credit fund series, which is the opportunity that you're looking at re-upping in today. So we think that really gives us an information advantage relative to many of our peers and having access to that amount of data. I'll stop there as consideration of time and turn it over to my colleague, John File. John is also one of the 11 partners and owners of Berkshire and runs all of our debt investment platform.
Thank you for having us here today. I'll be brief. My name is John File, portfolio manager. I run the predecessor funds as well here in the same strategy. I've been at Berkshire for over 10 years and in the multifamily debt space for over 20. Debt is not something that's new to Berkshire, although debt has been very prevalent in the market in recent years. It's an integral part of our DNA. It's been something that we've been investing in multifamily in the U.S. for over 35 years. Our CIO, myself, and our Chief Credit Officer have spent our entire careers, which is over 20 years, exclusively focused on multifamily debt in the United States. I think one strength and one value add that we bring to this proposition is our vertically integrated platform and applying that platform to a debt product. So not only do we have 27 investment professionals dedicated to this strategy and our debt platform, but we utilize all of the professionals in our equity and property management divisions as well to assist in the underwriting and the asset management of these investments. So 100% of the due diligence, the underwriting, and the asset management is done in-house at Berkshire. We don't third party or ask anybody to provide us services to do that. And then just to put a finer point on what Tom was mentioning, just in terms of track record, we've been investing in this since 2009. We are the largest investor and manager of this product. We've invested in over 3,600 loans since 2009, $3.5 billion of equity. 2 loans in those 3,600 have ever experienced a loss, totaling $4.5 million. So said differently, 99.99% of the investments that we've made in this strategy have been performing and have kind of come to the finish line. That will leave it there, I suppose, for questions and answers.
Great, thank you very much. Do we have any questions from council members?
What happens if these Freddie Mac gets spun off as they're proposing?
That is a question that we've been dealing with since the financial crisis. There's been various conversations, white papers, potential legislation to move that forward. I would say that we monitor that very closely ourselves and through trade organizations. I would tell you that proposals like that have never really made it much further than headlines in some initial discussions. It would take an act of Congress in both houses to pass any sort of significant legislation that would change both Fannie Mae or Freddie Mac. Both of those agencies are quite profitable right now, which also makes it more difficult to change things. I would also note that they are there to provide liquidity and hence affordability into the housing market in the United States. So the idea of privatizing them, I understand, aligns with certain political platforms, but doesn't necessarily also align with the mission of providing affordable housing. So it's something that we've been talking about deeply since this election, but don't believe that there's any significant risk, certainly within the commitment period of this fund, that anything happens. Should it happen, it would likely take many years to effectuate. Thank you.
And Member Summer, if I can just add something we thought about too, and I would say if, just in case they were privatized, the central mission for the organization would absolutely need to stay the same. It's too important to providing liquidity to the housing market, and if that liquidity role stays the same, the production of these loans will continue. So really, you would have a role even within a privatized.
Thank you very much. Any further questions? Hearing none, I will go ahead and make this motion based on the recommendations of the Council Investment Committee, by SIC staff and general fiduciary oversight from RBK. Move that the State Investment Council approve a commitment of up to $150 million to Berkshire Multifamily Credit Fund 4 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Motion by the chair, second by member Summers. We have a roll call vote, please.
Treasurer Laura Montoya,
Yes.
Nick Tass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer.
Yes.
7 in the affirmative, motion passes.
Thank you all very much.
Thank you. Thank you very much.
That brings us to our last voting item today, which is the National Private Equity Structure Study.
Mr. Chairman, this is Chris Constantine. Could I make a comment?
Please do.
So these structure studies, and I usually give this lead in every time we do one, these are really critical to the investment process. So we've got our broad investment policy. These structure studies are really where the rubber hits the road. So these are the plans that now will address the private equity markets going forward until we update you again in 2 years on that process. So it's a lot of guidance to the asset class directors from the council and for myself, the CIO, of how we're going to address these markets. They're really important to the strategy group in terms of understanding when we allocate to this asset class, what exactly we're getting to the others. And so they're really critical. And Chris has done a great job on this one, and we're proud of it. Thank you.
Thanks, everyone. It's on page 434 of the presentation. There's an executive summary of this lays out the main points of the strategy. We've obviously been talking a lot over the last couple of years as we bring investments what the strategy is. So hopefully none of this is a large surprise. Number one, obviously, the Permian Basin with the inflows there has increased AUM massively. This, of course, is a pretty large increase in commitment pacing relative to the past. When I first joined, we were making $200 to $300 million of commitments a year. That's obviously increased pretty dramatically in order to ramp up the portfolio. And as we've thought about ramping up the portfolio, and to do it in a way where we're, maintaining diversification, but also looking to find alpha, we think the right answer is increasing the number of GP relationships, increasing the size of our commitments, and then something we started last year is really increasing our co-investment activity, which we had not focused on in the past. And we're going to do that through a combination of side-by-side co-invest vehicles with our managers where it's feasible, and anything other than that through an SMA with Mercer, because not all the managers can do that for us. Number three, we also think the increase in manager count, there's still significant alpha available, we believe, in smaller managers that are focused on early stage and middle market buyout. We saw a couple of the early stage managers today that we're quite pleased that we've been able to get decent sized allocations in small funds that we think move the needle ultimately. So we don't want to vacate that part of the market, and we want to keep getting exposure there. It's roughly middle market buyout, it's roughly 2/3 of the buyout market, defined as companies of $25 million to $1 billion. So we want to keep access there because we think there's a lot of alpha available. Fourth, we're now a credible venture capital investor. We've had a huge effort to really build that program together with the New Mexico program over the last 5 years. And, groups like Bonfire and Aurora Hippo are, with evidence of a lot of effort over the last couple of years to try to gain access to great groups. So we are, in the past, weren't sure if we'd build access to these kind of groups. And so the last time around, we were 0 to 5% allocation, and we're recommending increasing that to 10 to 25%.
Sorry, what was that? Sorry, Mr. Cassidy, can you speak a little louder?
Yeah, so in our last structure study, when we weren't sure we'd have access to managers on the venture capital side, it was a 0 to 5% target, and we're now increasing that to 10 to 25% to reflect the fact that we're now getting access to the kind of management we wanted access to all along. And, you know, finally, in the structure study, we have a slide that talks about the differences between the national program and the New Mexico program. The New Mexico program is focused on areas where we think New Mexico has a right to win, deep tech, climate tech, other sectors like that. And up partners today, that's reflective of an effort on the climate tech side related to New Mexico. I don't know if Richard and Amy want to add anything beyond that. We'll take your lead as to how you want to approach it. If you have questions, or I'll leave it with you.
Thank you very much. Madam Treasurer?
Mr. Chairman, for me, if you could tell me what the differences are, I don't see, I'm looking through the presentation and I don't see a red line of what we had before, what we have today. So what are the differences?
Slide 462 talks about the different changes. Number one, we're targeting 30 to 40 managers for buyout, growth equity, and special situations, and 15 to 25 for venture capital. That's based on a little bit of a bottom-up exercise of our kind of where we see our forward pipeline over the next year or two. In terms of underlying strategies, buyout, growth equity, venture capital, special situations, no real change to buyout. That'll remain the core part of this portfolio. No change to growth equity. You know, in the commentary there, we discussed there's groups like TA Associates, which are core positions, which are more growth buyout kind of strategies, profitable companies versus late stage venture. That part of the portfolio will continue to be mostly with the more profitable growth kind of groups, or overweight that. On the venture capital side, this is the early stage part of the portfolio that we've been working to build. So that's the big change in terms of target, increasing it to reflect the fact we've been committing more capital in that space. And then special situations, this strategy is kind of a number of different potential strategies, but generally speaking, like Sweetwater today, you're providing liquidity to sellers and earning a premium for that. So all those strategies have a similar characteristics. We've brought groups like Bain Special Situations last year, a group called Arctos that does GP solutions and secondary. Today you saw a group called Sweetwater that does secondary transactions. On the next page, you know, we invest through managers that are largely multi-sector managers. They're the ones deciding how much. We generally have a pretty good idea going in what percentage of the portfolio they're going to put in information technology or healthcare or, you know, industrials. But we, generally speaking, leave it to the managers to make those decisions for us. We do invest in sector-specific managers where we think it makes sense. Healthcare and biotech being kind of the core example of groups where you need a very specific expertise to invest in that sector. But generally speaking, our managers, we generally keep in mind when we're overweight or underweight relative to our benchmark, which is we look at Burgess. But generally speaking, it ends up tracking pretty closely because our managers, it's a diverse enough portfolio that ends up being relatively close to the overall index. Then on the geographic side, we did increase the North American target from 60 to 80, which is a small increase. We kept Europe unchanged, and we reduced Asia and other EM a little, just by 5%. You know, we expect this portfolio to largely be North American. You know, a lot of our managers do invest globally as well, where they make the decision about how much money to put in Europe or Asia. We don't really expect to, we expect it to remain generally focused on US-based managers. It's easier for us as a group that doesn't travel internationally to have those relationships. I don't think we're missing much. Europe and Asia. Europe has performed okay, but no better than the US, and Asia in general has not performed either as well as North America and Europe, so we'll be very selective outside of the US and Europe. So those are kind of not a lot of changes, the big ones being increase increase in manager count to reflect the fact we're committing more capital, the venture capital target increasing, taking the special situations target down to 0 at the bottom end because it's a inherently more opportunistic strategy that will not necessarily depend on the market environment, whether there's an opportunity set or not, and then just increasing the North American target. So really not really massive changes. I would say the biggest changes overall are an increase in management count and the venture capital allocation.
Mr. Chairman and Mr. Cassidy, when you're looking at emerging managers, I noticed on page 465, you talk about or initial due diligence document to assess the high level quality. So I'm assuming you already have a document that you use to help identify who you guys think would be a good fit for SIC.
Richard, Amy, do you want to talk about your process as you go from meeting managers and your...
Yeah, so we have a process that we work alongside Chris and staff throughout the investment process. But, you know, when we meet with the manager, we'll produce a meeting note. If it's something that we've decided that we like and we think that it's going to be a good fit, we'll move it into full due diligence. If it's something where we need to learn more about it, we'll do an initial due diligence document to try to identify the pros and cons and discuss those in more detail. So that's what this process is entailing is, you know, it's not just we meet a manager, do the diligence and bring it here. I mean, there's a lot of months of work, you know, sometimes years of work before a manager is actually brought to the SIC.
And I would just say the funnel includes all, you know, funds 1 through and up. So our sourcing funnel does not cut out someone the SIC has approved 1, 2, 3, 4, especially as we continue to need to fill the small and middle market buyout bucket. We find a lot of newer emerging managers in that area, so that's actually an area that we see increased sourcing of newer managers. And then in venture, we see an emergence there too. But I would just say the funnel actually captures, we don't cut anything out just because of a fund number.
I think it's an important part of a program to be constantly refreshing. You know, some of these managers, they get a little big and alignment's not as good, and maybe they get a little, you know, some of the funds in their early life are actually quite hungry. So, you know, we are looking for those too. We saw 3 examples of that today, or really 4, frankly. All those managers are smaller. You know, the Sweetwater's really a kind of a fund 3 effectively. Up Partners is a relatively new manager, and so you know we have some things in our pipeline early next year that are newer managers, and I think that's something you always want to keep that fresh because the next generation of folks that are going to be hungry and providing alpha.
And Mr. Chairman, I absolutely agree with both of you, and because there's an increase, I'm just hoping there's a way to streamline the opportunity for some of those emerging managers. So that's why I was interested in getting a copy of the due diligence document or what your requirements are, so that as you're looking at new managers, I want to make sure that we're not eliminating anyone because they haven't been here for a long time or because they might have an AUM that's a lot less than some of these bigger ones. So I wanted to see how, or if you've already thought of, or if it's already in the strategy or the paperwork that people fill out to decide to start trying to build that relationship with you, how are we making sure that we're allowing the doors to be opened enough to allow some great opportunity for some really good emerging managers to come into those doors?
I think it starts with having an incredibly wide funnel, and you know, part of the reason I like working with Mercer is they have that wide funnel where because they have a larger team, which I believe is 50, 60 folks, they can actually look at smaller funds. And a lot of this, my personal view, is a lot of it comes down to being willing to look at smaller funds. It's in theory easier just to write checks to these big platforms, but I would argue there's probably less alpha available there. The alignment's generally not as good, and you know, you are missing out on the next generation of folks that are hungry. And we're certainly not closing the door off to that, nor is Mercer. So it's a wide enough funnel where we you'll see that, in some of the funds we're bringing right next year that, you know, we do a lot of work to try to find folks in the lower middle market and mid-market, the next generation of groups, and the kind of funds. I wouldn't necessarily say Fund 1, but Fund 1 through Fund 4 maybe, because that's when,
And I would also comment, I think that's a great point, Treasurer, on our due diligence. So we actually don't change the due diligence process because you might be a Fund 2 or 3. I think with a Fund 1, we actually, our resources help us where we will take the time and the network, and we will go and spend a lot of time, because a lot of time these managers are coming from some other firm, and a lot of times they can't bring their track records with them. And so we'll spend a lot of time understanding what that track record was. So I think when we say differences, I think in the Fund 1, we'll spend some more time just reaching out and trying to put together a track record if they weren't able to bring it. But I would say no difference, in our ratings or our due diligence. We don't have a special set of standards. We really want everyone to be looked at fairly and using the same, we look at strategy, track record, alignment, and the team. And so we spend a lot of time on those things, but I wouldn't say it's anything different. I agree with Chris. I think the sourcing and being open to, I think with the addition of capital, that's also really opened the funnel. As we've been looking at our pipeline, we do have a lot of smaller and emerging managers on there. So I would just make that comment. We definitely don't want a different diligence standard of any sort. One thing that we do sometimes, we have a separate operational due diligence team, so we do ODD on all the funds, and we are very active in working with newer managers that might be getting up to speed and putting into, establishing different processes and best standards, and we'll very much give active feedback during that time. If something's coming up short, we won't just seeing someone and say, come back in the next one, hopefully you fix it. But we very much try to work with managers so that they can build best in class from the start. So I'd say that's another area that we work with newer managers on.
So I would say whatever we have done in the past on some of these aspects, I think there's room for improvement. And to Mr. Cassidy's point, the idea of opening up the funnel enough so you can have the variety and the diversification of fund managers within only helps strengthen the portfolio in itself. This might be a dumb question, but is there an actual policy for this strategy or like a red line on the approval of what we're approving today? Because I see the points on here, but I'm just so used to like a policy with red line of what we changed or a document that you are utilizing.
we kind of planned similar to what we did, I believe, was it your return? We plan to bring the specific IPS at a later date after this discussion, so we'll make those changes to the document. I forget exactly how that was evolving, but whether it's one document or separate documents, but yeah, that would be at a later meeting.
So I would prefer, Mr. Chairman, to vote on something that I can actually see what the document changes look like than based on a presentation personally. That's just me coming from the legislature for so many years. I feel more comfortable reading the actual implementation of the changes on an actual document that they're going to utilize to implement their work. Thank you.
Understood. Thanks, Treasurer. And I think if I understand correctly, what we're really talking about is two votes, right? The chance to vote on this presentation and then the chance to vote on the red line investment policy when that is brought to us. So I think we'll have the opportunity to do that. Future? Yeah.
This is a question basically not necessarily for you, but for you and Vince. As you increase the number of managers, personnel and time it takes to do this is going to increase dramatically. I'm sure you're going to address this next week, but it seems to me that this is a very time-consuming process and labor-intensive on your behalf. So as you increase these managers, what do we need to do from a staffing perspective to address this?
And Mr. Chair, Mr. Summer, you're exactly right. This is going to be a topic of discussion for next week. One of the national experts who's coming in has specifically taken a look at what is the size of both alternative and non-alternative investment teams at organizations similar to ours, and then also adjusted everything on a staff unit per AUM basis to try to get an apples-to-apples comparison. So you'll have a lot of great information to look at for that.
Mr. Chair, so as we increase managers, the increase in work primarily has been monitoring. So the run rate that we bring of managers is relatively stable. I mean, it's increased here the past few years, but it's relatively stable now. It's the monitoring capabilities. Right now, that's mostly outsourced to the consultants. We need that organic capability in-house, and we need to expand the team to do that. But right now, it's being handled by consultants.
Okay, any other questions?
Mr. Chairman, I think that we need to move to table this until we have our retreat and we have a red line in front of us as to how this will be implemented with an analysis of it. We're putting the cart before the horse.
Okay, so Madam Treasurer, if I understand correctly, you'd like to basically just have one item where we could review the presentation and the IPS red line together and approve them concurrently at a future meeting?
Yes, I think that would be helpful in us having a discussion during the conversations we have for the 2 days that we're on retreat next week, especially with staff to better understand what they're doing, because anytime we change a policy, we have to look at the fiscal impact, how this changes the structure, how it changes staffing, how it changes a lot of things that we can't really talk about right now at 12 o'clock. So I think this is a good way for us to get our ears perked to start paying attention so that we can do this right, but especially because this is a strategy that will, or a structure study that's going to change a lot of what we're doing on that area. I think it's important for us to do that.
Okay. And I would just ask our Chief Investment Officer or others on the staff if that creates any issue to delay this item.
There's no issue here, Mr. Chair. This is an outline of what we intend, or how we intend to approach the market. The actual policy is what Chris was talking about, we'll bring to you. So they're two very different documents. This one that you just reviewed is how we intend to approach these markets. The actual rule set, the policy comes, and you'll get the red line version of that. If you want to do them in the same month, it's not going to cause the same problems. There's no operational problem.
Okay. So should we take that as a motion to table then from the treasurer?
Yes, Mr. Chairman.
Second.
Second from Member Tejas. Take a roll call vote, please.
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
With 7 in the affirmative. Motion.
The table is passed. Okay. We have received a request for a break. So unless anyone objects, I would propose that we break until 10 minutes past 12 Mountain Time. We'll resume with item 4 on the agenda at that time.
I saw it, I had a question.
And I know we have some people catching flights. We did receive a request to move up the private debt presentation. Maybe we could do that after the RBK, if that works. I don't know if Mercer also has a flight coming up soon. Okay, so let's move on to the RBK, performance report. We will then do the private debt CMR, and then proceed with the rest of the items under number 4.
Okay, thank you, Mr. Chair, and good afternoon, everyone. We do have your third quarter executive summary in the packet. This is in the second attachment. Brent has it up on page 481 in diligent, page 3 of our materials. It's always just a brief introduction in terms of capital market review and setting the basis for what you'll see in the subsequent pages. The bottom left-hand side, you can see the market performance as of September 30th of this year, trailing periods there. And as you look at that QTD quarter-to-date column, which represents the third quarter, you can see some very strong returns, particularly out of equities, but really all the way down the line. S&P 500 continues to inch higher, outperforming over the longer time periods as you move out calendar year to date. And 1 year you can see very substantial double-digit returns, but in the more near term, you actually saw non-U.S. foreign markets pulling strong returns as well, and that was largely driven by a softening dollar, although a lot of that has since reversed in subsequent weeks. I think one of the things, too, that of course has happened, we've talked about that in the past, but it's continued to extend further, is the concentration in some of the U.S. large cap indices, particularly the S&P 500, the top 10 names, all those names that you've seen in the press, tech-related, Apple, Meta, things like that, NVIDIA, of course, are now representing over a third, 35% of that index. The other 490, the other 2/3. So, of course, it's been nice to see these very strong returns. It's been accretive, particularly for risk-on portfolios, but just want to put that out there in terms of context in what's driving these returns. Emerging markets also has done nicely here, 9% for the quarter, and solid double-digit returns for the 9 months so far in 2024. As you slide down further, you see fixed income performance also really added meaningful to a diversified portfolio. In part, you can see what has happened there on the right-hand side, Treasury yield curve, the blue line versus the green line. Vince already mentioned that at the September meeting, we had the first rate cut by the Fed in 4 years. That's reflected in that short end of the curve moving down, but really the entire curve shifting down, and that, of course, has an inverse relationship with prices, so it's benefited the overall fixed income space. I think some more volatility around interest rates. I think the broad theme now with the election behind us, that we'll continue to see some volatility. There's, of course, some strong expectations and how certain things will materialize, but at this point, it's mostly rhetoric. We'll have to wait and see in terms of what policies actually move forward, but certainly there seems to be quite a bit of enthusiasm in more recent market returns. And I think that the last thing I'll say is that, of course, we talked about cash and some liquidity on the books. Some of that is being deployed as quickly as possible into the markets, and despite the Fed moving the short end of the curve down, we're still having cash rates north of 4%, and inflation reasonably moderate. Still not where the Fed would like to see it, but at more reasonable rates than what we have seen in the last couple of years. We're still earning a positive real yield, so not a tremendous opportunity cost, at least from a capital preservation basis on having that liquidity on the books. So I'll stop here in the interest of time. Always happy to take questions or comments. Otherwise, Marcia will make a few comments on the portfolio.
Okay, I would suggest maybe if Marcia could share those comments, and then we can take questions.
Okay. So, thank you. Okay. I'm going to take you to page 484 and just make a couple comments
this policy executive summary review is structured like a policy where you start with your most important decision, which is asset allocation, then you go to your total fund, and then by asset classes, and doesn't really address managers at this point. So the first part of this is looking at asset allocation. I just want to note another thing, that we're working with Nino and staff on changing this executive summary, so we'll bring you some drafts, and this is your report, so we want it to fit your needs, and we're working with Nino on it. So the first part, Vince spoke to it, working real hard to move you to your targets and your interim targets. That's shown in these first several pages where you see a lot more green than red. And to the treasurer's comment about cash, we show the cash in each of these allocations. And, you know, it's not always coming from cash that deploys into the private assets. You rebalance all the time to when you make those investments. So again, there are 3 funds that have interim targets. If you look through this, I'm not going to review them. You'll see that staff's been hard at work getting you close to your long-term target. And in the cases where there's interim, you're much closer than you were. And I think, as Vince said, over the first of the year, you're going to see them even closer. So with no comments about that, I'll take you to total fund, which is moving us to page 489, and this is looking at land grant and severance. We have obviously the performance for all the funds, but just looking at your policy expectations for the performance of these 2 funds. Land grant, for the investment policy, you have a 5-year, you want to look at performance, longer term, so per your policy, that's 5-year. You've met your policy expectation for the land grant. You have not met that policy expectation for severance. We talk about that a lot. Part of that is it's a little bit different in allocation, and also the private equity portion and the ETI and the severance tax. We show attribution on pages 490 and 491 for the quarter, and for the year for land grant. Suffices to say that asset allocation is driving all of your return. You outperformed in each of those time periods. For the quarter, not being at your target was actually additive. That's on page 490. And also there was some manager value add. The story on 491 for land grant is same, certainly driven by the asset allocation. Being away from your target was pretty neutral. And then there was more manager value add here for the managers, with the exception of your private market fixed income, but we've talked about that, and you'll see in a moment for the quarter that you actually turned the quarter and you outperformed your benchmark. I'm going to just point out on page 494, again, this is on a calendar year date basis, but looking at total fund at the very top, this is everything. This is all the permanent funds. This is your external clients. So at the end of September, you were at almost $58.5 billion, remarkable returns. You can see that the net cash inflow through September was at $4.8 billion. And only $160 million of that came from your external clients. So it's all land grants here, not here today, but it's all coming to you from the Land Commissioner's Office. Page 498, again, looking at total fund, not an objective, but looking at how you've done against your peers. I'll just look at the top part where it's looking at the land grant and showing the land grant rank for each of the time periods, certainly below median for the shorter time periods, but remember, we've been in a market that Matthias just went through. It's been all public equity, strong performance there. You're underweight many of your peers in your public equity, specifically in U.S. equity, a little bit over in your non-U.S., but that was a headwind for you for the shorter time periods. But if you look longer term, for the 3-year top quartile and above median in the trailing time periods against your peers. And that's reflected on page 499, where we're looking at rolling 5-year periods of your peer ranks. And you can really see for this right-hand side of the page that for most time periods, you're above median, exactly where you want to be. And on page 500, looking at sharp ratio, so risk-adjusted performance, risk-adjusted return, you're ranked in the top quartile and have for a significantly long time period. With that said, asset class performance is shown in the back. I think I'll just summarize it in the sake of time on 505. There's been no manager changes. This is just looking at each asset class, and I'm just going to cover the public. So for U.S. equity, you've had strong performance. The markets have been up, but and historically you've trailed the benchmark. You have short-term, 1 year you're still ahead, but there's been changes to that portfolio. It's more index-like. So the underperformance, in part, is just the fees for the shorter-term period, but outperformance for the 1 year, and for the 3 year, just the 2 basis points underperformance. So that's really incorporates the change for the structure. Looking at non-U.S. equity outperformance, public markets, long-term, you've had on fixed income, nice outperformance. A little bit of a headwind on the short term due to some short duration. And the rest you're going to hear from your public market managers. So with that, Madam Chair, Mr. Chairman, I'm sorry, we'll take any questions.
Absolutely.
I am so sorry.
No problem. Any questions for RVK on the performance reports?
May I just make a suggestion since you're looking at the design of the presentation? The way that you have the green and the red, it's really helpful for us, especially when it's after a long day that you're reading the 1,500 pages. So I appreciate that. If we did the same thing for the no and the yes, I think that would be really helpful because that helps us pay more attention to specific areas. And the other thing that would be helpful for me is you guys have a sheet, which I've been looking for and I can't find it, but it has the dollar amounts and it has all of the listing. I know I saw it last night. But when you're looking at each one of the different pools or portfolios.
494. 494. I think that Madam Treasurer.
Yes. So that would be helpful when you have the design of each one of the different ones and the percentage to have the dollar amount on the top. And the reason why I say that is because if we're off a little bit on something that only has, I wouldn't say only, but is a smaller pool versus like early childhood or severance tax, it's very different as far as the dollar amount, if that's relevant to it. So for example, on page 494, the only question I had on that, I noticed the percent of return was 3.59. And I was just curious what was going on with the sorry, not severance tax, it's the tax stabilization reserve. And
Tax stabilization, that is the one that has, yeah, it's all, if you wanted to go to 485, you'll see that is all fixed income. That portfolio is being paid out, as you can see by the net outflow there. So there's no equity exposure there. And then you do have private markets, but it's fixed income and real estate. That's on the top left hand of that chart. So no equity exposure by design.
Yes. And then I did notice interesting perspective on the external clients we never usually talk about, that you had a 2% return documented on there. And I thought that was really cool for the members to see. And then as far as your graphs on the little dots to see where we're at, the goal is the top left-hand corner, correct?
What, can you,
Like page
Treasurer, reference the page.
503, like risk return appears whenever you.
Oh, yeah. We want you to be in the northwest quadrant, and land grant is on the top. The green is under the yellow. So the land grant is in that northwest quadrant. Severance tax is not. Madam Chair, may I ask you one question?
Okay.
So when you're saying,
Thank you, Chairman.
back to that one, may I ask you a question, Madam Treasurer? So when you're saying on that one page that has all the funds, that you want to see it by size, not by time, those are listed in when they become funds. So we'll switch it if everyone agrees to being size. That's, I think, what you're asking.
I would just note, I don't believe we have a quorum, so if it's possible to maybe
We'll still vote.
add an exhibit rather than take one away, just
Okay.
in case the other members feel differently about
Thank
it.
you.
Yeah, I think they give two different perspectives. I could have sworn I saw a page that had all of the funds listed, and it went from the largest amount to the lowest. I know I saw it, but having that dollar amount, I usually pull that page out and I put it to the side so that when I'm going through each one individually, it doesn't have the dollar amount, I still see it. So just since you guys are looking at how to change these, when you're looking at a snapshot, when, for example, page 4, okay, 484 allocations, putting the dollar amount, what the land grant total is, so that you can put it in perspective to what you're looking at on the asset allocation. I think it's helpful because then we don't ask questions like, for example, the tobacco settlement. There's hardly any money in there, but as a new member, I wouldn't have known that. So seeing that not exactly aligned, exactly where you should be at on that target isn't as big of a deal when it's a lot less money that we're talking about in general versus something in the land grant permanent fund. So just
Madam Treasurer, thank you for your feedback.
Thank you, and I'd like to recognize our council.
Hi, this is Evan. I obviously respect everyone's time and their input. In an abundance of caution, just to protect all the council members, I want to apprise everyone that we've just lost a quorum. And so I think that having an informational discussion is absolutely fine, but to the extent that we are comfortable avoiding policy and or taking actions, no matter how slight, going forward, I think that would be the safest course of action under the Open Meetings Act for purposes of the remainder of this discussion. So again, informational questions just fine. To the extent we start doing things or making policy, I doubt we're not voting, so I doubt there'd be much issue there, but I'm compelled as your counsel to just sort of say, be careful about doing things.
so Chairman, now to his point, we're not taking any actions. You've asked for some suggestions, and that's one of the suggestions.
We're changing the reporting respectfully, Madam Treasurer.
Say that again?
We're potentially changing the reporting, Madam Treasurer, very respectfully.
We're adding in the dollar amount that's already on other sheets, just using it as a formatting. That's all I'm asking for.
Absolutely fine. I'm just protect you all the best I can.
Understood. Okay, thank you for that guidance and, that discussion. Any other questions for RBK? Okay, let's move on to 4F, the private debt PMR with Director Lofton and.
Thank you, Mr. Chair. In the interest of getting Mary to her plane, I'm just gonna turn it straight over to her.
And suffice it to say, we obviously would like to go through these relatively quickly.
Yeah, absolutely. Happy to. Thank you so much to the council, for accommodating this schedule. So I am on page 634 of the presentation. I will not go through this page by page. Many of these, are redundant. They're just presenting information that's presented previously in the report in a different way. So let me begin by reminding the council that you have adopted a 15% policy allocation to private credit. The inception of the program dates to 2012. However, at that time, that program was of a very different construct. It included a heavy allocation to hedge funds as well as to traditional fixed income. So when we were retained in 2023 in concert with Director Lofton, added his direction, I should say rather, we being you, adopted a new structure. And so that's why when we present our performance, what we're presenting is both the IRR that dates back to 2012, as well as the IRR that we believe is more representative on a go-forward basis. So let me start there because effectively that is kind of the punchline. When you include everything that's inclusive of traditional fixed income, which is not at all representative of the go-forward program, you have an IRR of roughly 6%, 5.9%. If you strip out the traditional fixed income and the hedge funds, your program performance is 9.5%, which is more in line with what we expect on a go-forward basis and certainly compares favorably to the public market equivalent of 7.5%. So that's why we think it's important to make that differentiation, and that's what's driving that. So in terms of the number of investments in your program, you have 58 line items. You have committed $9.1 billion. The current market value of the program is roughly $4 billion. If we turn to the next page, I would just quickly remind the trustees that you adopted a strategic allocation in 2023 that reflects this new orientation and this new breakout in terms of direct lending, asset-based lending, special situations, diversifying, and then again we have the liquidating share class, which is going away, as well as the legacy exposure, which largely ties to some side-pocketed assets. Again, the focus of this program on a go-forward basis is to focus on yield and income as the primary driver of return, with a focus on using your scale to secure best-in-class execution from a fee perspective, as well as focusing on compounding through the reinvesting of income. I would draw your attention to the next page, which provides further granularity in terms of this breakout by strategy, and that provides further detail in terms of the difference in terms of the program's return when it's inclusive of the liquidating share class, the liquidating and legacy share class, and excludes that. So with that, I'm going to actually draw your attention forward. Sorry about that. To page 638 of the presentation. Oh, I apologize. I'm going to actually spend 1 minute on 638 of the presentation. This highlights the commitments that we have done for you year to date. So year to date, we've done 11 commitments for the SIC in the private credit program, representing $1.9 billion of commitments. The expectation is that we'll do a similar amount the next few years. The next number of pages effectively provides the same information broken out in a number of different ways, so I'm not going to focus on that, but I'm going to draw your attention to page 646. So I'm going to jump forward a number of pages in the presentation and draw your attention to what I think is hopefully a helpful understanding of the performance. Again, splitting out kind of that pre-restructuring and post-restructuring performance of the program, and doing it on a horizon IRR basis. And so if you look at the performance of your program since 2023 on a one-year basis, because looking at it on an annualized basis, that's the only period of time we don't have a three-year track record or a three-year period to highlight, the performance is 14.9% IRR. So obviously the program is inclusive of the history as well as the go-forward, but we do think on a go-forward basis, this 14.9% is hopefully more representative. Obviously, that's been done in a very favorable high rate environment, and as Treasurer Montoya highlighted, we are likely to see a decline in rates, so we do expect absolute returns to trend down. So with that, I'm just going to spend a quick minute as it relates to the performance environment. And what I just want to draw the trustees' attention to ties back to direct lending. And so we've got a few slides in the presentation. I'm not going to tie to any of those directly, but I would highlight that we have seen modest spread compression in the direct lending space, roughly 100 basis points. So we have seen an uptick actually in terms of original issuer discount. So the punchline is that returns in the direct lending space have come down roughly, and so we're kind of expecting 10 to 11% on a go-forward basis. We had been expecting kind of 11 to 12%. So just to draw your attention to that. We would highlight that there's still a significant supply-demand imbalance in our world, oftentimes finances the private equity world. So we often focus a lot on tracking the dry powder in private equity versus the dry powder in our space. So if you compare the dry powder in private equity, the latest statistic that I have is $629 million. It's roughly, and the dry powder that's in the middle market direct lending space is a third of that. So there's significant financing. There's still a significant financing gap to be had and to be addressed. So we're excited about our market. We think there continues to be tremendous opportunity in it, and I'm happy to take any questions.
I'm just going to throw in that what Mary just mentioned about what's going on in the direct lending world. It's really good that we started early on diversifying into the asset-based finance world, and that helps us. That helps diversify what's going on there right now in the direct lending.
Yeah, to Tom's point, we haven't seen as much spread compression in the asset-based lending space as we have in the direct lending space. And also, we haven't seen as much competition coming to that space relative to the direct lending space. But.
Thank you very much. Any questions for Director Lawson or Nikita?
One question, Chairman. Great presentation. Just for my own brain's sake, on the IRR that's listed and it says NM, is that because you don't calculate that into the percentage of the total return for this portfolio because those were assets that were utilized in the New Mexico Fund? Or why
I'm sorry, are you referring, what page are you referring to, Madam?
640, 641 on the last
Yeah.
call.
So what we're showing, oh, I'm sorry. Yeah, so generally speaking, we don't start showing an IRR unless there's at least 1 year, generally 18 plus months of return history. So some of the newer investments, that's why it's NM, not material.
Oh, not material. I was thinking New Mexico. I was getting confused. So that.
No, sorry. Now look at. Sorry about that.
The second point I would mention. So probably an asterisk non-material would be good, but I guess if you're not in New Mexico, it wouldn't matter. But the other thing that, to be fair to you guys, when you're looking at 2024 or 2023, saying it's a 14% net IR isn't really fair either way, because you're just starting in this world. It takes years to get to a true IRR, correct?
Yeah, I'd say one of the differences, yes, so you certainly see a much shallower J curve in private credit than you do certainly, relative to private equity. So that's why, generally speaking, we're comfortable reporting an IRR in a yield-focused strategy, not in a capital appreciation-focused strategy, kind of in the second year of the program. So I hope I'm not implying that we think that a 14% go forward IRR is representative of this program. That's not what we're trying to communicate. We're just trying to communicate that there's a material difference in terms of the historical performance of the fund, and we don't want you to see that return disparity relative to the public market equivalent and focus too heavily on that, given that the program had been focused largely on hedge funds and traditional fixed income, and it wasn't a private credit program.
And Treasurer Montoya, I have a little bit of a broken record here, but several of our first or earlier commitments were asset-based focused. They're going to have shorter durations. There's going to be greater returns. They're not going to be like a direct loan that can be a 5-year or 7-year loan. They're going to be much shorter duration products. So in many cases, those have already turned. They've already matured and reinvested.
Yeah, which is why. That's great. I feel really good about this one, and the moving forward of removing hedge funds so much from it all. So thank you all for your presentation.
Thank you.
Thank you. And unless anyone else has any other questions, I did have one question on 635, just looking at the asset-based percentage of market value being 9%, the target's 25. Is some of that there's undrawn commitments, or should we expect to see, a bunch of sort of asset-based commitments coming forward?
You should expect to see additional asset-based commitments going forward. A lot of it has to do with the focus of the program in terms of the private credit allocations that had been done. They were focused on special situations. Also, one of the things that you're going to see going forward is you're going to see that diversifying come down significantly as we're going to introduce, in this one, please, Evan, tell me if I'm overstepping. We're looking to introduce like a specific line item for commercial real estate debt, because currently what we're doing is we're including that under the diversifying, so to provide you with more granularity so you better understand, the structure of the program. That's something that we're looking to do based on whatever approval is required.
And honestly, to the private equity structure study presentation earlier, it takes time to evaluate many of these managers. For many of them from Carval, we met with them for almost 2 years prior to bringing that to the council. So yes, we've set relatively aggressive targets for asset-based investments, but it takes time to diligence them and winnow them down to the bottom.
Thank you. Any further questions? Okay, thank you very much. We'll move on to item 4B, National Private Equity Fund Summary and PMR. Mr. Cassidy and Richard.
Thank you, Mr. Chair. I'm going to hit on 4 slides, which I think is a high-level summary of what's going on with the quarterly performance of private equity, and then happy to take any questions.
Page 50 in the second pack.
I'll start on page 50 in the second pack. So during the quarter, we had a gain of 1.2%. That was actually similar to the gain that we saw in Q1 of 1.1%. That equates to about $46 million of value. The one-year return is 3.9%, which is below what you would expect a private equity portfolio to be, but it is consistent with the private equity industry overall, as we've seen with the global private equity benchmark. Overall, though, the since inception return didn't really change much. It's at 12.1% on a total basis with an over $4 billion gain. And when we break the portfolio down to that 2011 and after, you can see the since inception return is at a 15.2% with an over $3 billion gain. When you go out on that timeline too, from the quarter and the 1 year to the 5 year and 10 year, you'll see the performance improve significantly, especially the 2011 and after. I'm going to skip ahead 2 slides to page 52 in the second book and talk about the net asset value change. The net asset value did increase by $22 million, and if you look at the chart up below, I mean, really what drove it was the gain in the portfolio. We actually had more distributions than contributions in the portfolio, which is something that we don't expect going forward with the commitment activity that we've had. The net distribution was $24 million. Through June 30th, it was $30 million net contribution. What you're going to see in the next quarter report is that net contribution is going to increase significantly, because we started seeing these new commitments draw capital at an increasing rate, and so we're actually at a much larger net contribution for the year. You're going to see that also contribute to the net asset value increase, which helps the allocation of private equity in the overall portfolio. Switch ahead 2 slides, the performance by vintage year. One of the things you saw in the structure study was a goal of outperforming the benchmark. The median returns in the benchmark. And I mean, this shows a by vintage year look at that, and you can see, going back, looking at the 2011 and after portfolio, that it has, the portfolio has outperformed the benchmark in every year except 2013 on the multiple, and it's just below the cutoff at that point. And then the next page is another benchmarking, which is the public market equivalent compared to the public benchmarks. And you've probably heard about this in the news where they're comparing private equity to public equity. Public equity, as we heard with the concentration in public equity, there's been strong performance there. And you can see actually on a 10-year basis, the national program has underperformed the Russell 3000 by 0.2%, which is where a lot of that concentration is. When you take the large tech out, you focus on the 2,000 smaller companies in the Russell 2000, the national program is actually outperforming by 4.5%. And then when you look at even a more diversified global benchmark like the MSCI ACWI, we're outperforming by about 5%. So I'll leave my remarks there. Happy to answer any questions, Mr. Chair.
Thank you very much. Any questions for Mr. Pugmire or Director Cassidy? Okay, hearing none, let's move on to 4C, Mexico Private Equity Fund Summary and PMR.
I believe this is starting on page 69 in book 2. The New Mexico program performance, you've heard some of that indirectly through talk of the severance tax performance. The New Mexico program performance was down 3.6% this quarter. Last quarter it was basically flat. And prior to that, we had seen some negative performance from some write-downs, particularly in the co-investment funds. And if you look at this table below, you'll really see the contribution of the co-investment funds to the overall performance across all of the time horizons. And it's been a $96 million loss across all the co-investment funds as of June 30th. That's caused the program to turn negative. It's a negative 1.4% since inception, which equates to a $68 million loss. We have seen some positive performance from the 2016 and after fund investments. That equates to about a $33 million gain, a 6.9% net IRR. A lot of these commitments that you've been approving over the last few years, though, it's still just too early to see how the performance is going to pan out on this. You also saw with some of the funds that you looked at today, where the more recent funds are either negative or have low performance, just because it takes time for these venture-backed companies to develop. But one of the things, when you look at performance, a lot of it was done from investments in the past, which is what's driving it. And I've talked about this before, but it's always a good reminder. The portfolio was very concentrated when we came in. It was 75% of the value was with one manager at the end of 2018. 76% of the value was in 3 companies. And we've really worked to diversify that exposure away over multiple years, because you want to get vintage year diversification in any private equity program. And that exposure has now dropped to 23% for one manager is the highest, and 29% for those 3 companies. So we have been able to diversify that portfolio over time. And then I wanted to skip to the economic impact update on the New Mexico program, because there is some good news here. The total New Mexico-based companies receiving investments in the program is 126, but I think the really good news item is 8 companies have received investments over the last 12 months. And a lot of these companies came from the new commitments. Some of the new commitments were this year. There was one fund that was approved in January that actually made a New Mexico investment. And, across those 8 companies, about $15 million was invested from the funds into the New Mexico company. In total, including follow-ons into existing New Mexico companies, $27 million has been invested over the last year. So that equates now to $389.5 million from the SIC going into New Mexico-based companies, and then from the funds themselves, so that includes other investors that are also in the fund, $547.9 million has been invested. So we are starting to see progress on the number of companies. That's something that we're pushing with a lot of these fund commitments. We wanted to see more companies, so that gives more opportunities for venture capitalists to look at multiple companies and potentially find opportunities to invest. So I'll conclude my remarks there. I'm happy to answer any questions.
Thank you very much. Any questions on the New Mexico summary and PMR?
Just one clarification. It's $389 million that SIC is invested in New Mexico. The $547 million, is that an additional or including the 389?
So it includes 389. So what it is like when you make a commitment to a fund, say a $20 million commitment, and then they have $100 million of other commitments in there, it includes the 589 number, the 547 number includes the other $100 million of commitments that's not related to the SIC and the fund that also invested in the New Mexico company.
Thank
So
you.
there's a magnifier effect when we go into a fund that raises outside capital that is focused on making a New Mexico investment. So we're trying to magnify the SIC dollars.
Madam Treasurer, any further questions?
No, I just think that's really a wonderful point to put out. I know that they've been working really hard on expanding and strengthening this program. So I'm excited to hear those numbers moving in the right direction.
Thank you very much. Okay, that takes us to item 2B, 4D, the real assets PMR.
I think I'd like to jump off with just one comment, and that is if you look at the historical performance broken out by segments, ag, timber, MLP, energy, infrastructure. Infrastructure is the only one of those listed subgroupings that has outperformed the CPI related benchmark over that interval. That would be one of the topics that we're looking at addressing in the structure study coming up early next year. With that, I'll just hand it off to Amy.
Great, thank you. So we'll start on page 571 in book 2. The slide titled Performance Overview. So in Q2 2024, there was a quarterly gain of 2.5%, or about $82 million of value gained in the quarter. As you can see, there's positive performance across each of the time horizons. Your since inception 6.6% net IRR is up slightly compared to last quarter. And importantly, your since inception gain in the total portfolio for real assets is $1.3 billion. On the next page, you'll see the year-over-year performance by strategy. I did want to point out, I know there's the question earlier by Madam Treasurer about the agriculture, so you actually see that split out here. On the top, there's 4 current fund investments within agriculture. It's not been an area we've been specifically focused on. Our last investment in there was in 2017. Again, there'll be more to come on as Keith and I present the structure study coming up shortly, but I did want to point that out that is available on this slide. The other thing I wanted to just point out quickly, there is an increase in both the IRR and multiples when you look at it on a year-over-year basis. And you see the commitments largest to energy and infrastructure. However, the largest NAV, which is the current value in the portfolio, is heavily weighted to infrastructure, as that's been where we've been very focused in the more recent years. The next page, we have the NAV, or the net asset value bridge, over the last 2 quarters. So you see the net asset value increased $93 million during the quarter. This was really driven by 2 things. Your contributions outpaced your distributions, and then you also had an $81.6 million gain within the portfolio. Similar to last quarter, where again, contributions larger than distributions, but you're also seeing a gain in the underlying market value of the portfolio. And we did want to point out 38 funds reported a gain within the portfolio, 17 reported losses, and 2 remained flat in the quarter. On the next page, these are the top cash flows and then gains and losses. So on the left-hand side, again, you see contributions on the top. They outpaced distributions. And then on the right-hand side, the gains were higher than the losses, with your largest gain being your MLP holdings. And it's doing what we'd expect to do. Your top contributions were all from more recent vintage years, 2022 through 2024. So those are the funds we would expect to be calling down the majority of the capital today. And your distributions are from your older funds, in this one, vintage year 2014 through 2017. So those are very much focused on exits. And an important metric we like to point out, so 4 investments, 4 funds produced gains over $5 million, so each of them, and no investments produced a loss for $5 million. And the last slide that I will hit on is the public market equivalent performance. This shows the public market equivalent over the last 10 years by calculating an IRR using the cash flows from the portfolio. And we do this against the CPI plus 3% premium. And you see the portfolio today is slightly above that PME. So with that, Keith and I are happy to take any questions.
Any questions on the real assets PMR? Hearing none, thank you very much. Move to the real estate PMR, please.
I think I'm the last one to report, so we'll, in this, going along with the theme, we'll be very brief. You know, we're presenting June 30 data for the real estate, and so we're a little bit lagged already in terms of the reporting numbers, but this is really a little stale now because after June 30, the Fed started cutting interest rates. And that's really changed the investment climate and the feeling and the outlook towards real estate. So I'm just going to cover 3 items quickly in this report, and obviously we'll answer any questions you have about our report. But as of June 30, your program, you were targeting about $5 billion to be invested in real estate, and you're sitting at about 3.76. So you're almost $1.5 billion short of where you want to be in real estate. And we'll talk about this in a minute, but the program's made a lot of commitments. But because the last 2 years the market has been completely stalled, basically all of those commitments, the managers aren't investing the money. The market's declining in value. Managers don't want to put a lot of money to work when the values are declining. So they're sitting on a lot of capital right now, despite a significant amount of new investment. And I think that puts your program in a good position coming out of this downturn. On page, I'm on page 592 in your book. Sorry about that. You can see the performance here, and the bottom line on page 592 is real estate. Your real estate program is performing very well relative to your benchmark. The challenge is real estate hasn't really delivered much over the last few years. In fact, if you turn to page 593, we kind of break down the returns on a calendar year basis, and you can see on this chart that your figures are in the blue colors, the benchmark is in the green colors, and you can see on this chart that you pretty much consistently beat your benchmark, and the program is delivering solid 10+% returns year after year, with a really crazy year in 2021, which was kind of that post-COVID explosion that we had when the Fed cut rates to really record low levels, and then the Fed turned things around and the party was over. So for the last 2 years, since middle of 2022, the market's been correcting, and the market's down about 20% over that last 2-year period. There are a few bright spots in the portfolio, and if you move ahead, let's see, to 596, I think. But yeah, 596 shows the capital that was put to work, and you can see the ramp up as we started to plan for a much greater growth in your portfolio. And again, most of that capital, the manager's been sitting on it, but you've been investing about $1 billion a year in real estate for the last 2 years now. And that's what we would call, kind of like dry powder that's waiting to be invested as the managers really start to put the money to work. But on page 597, diversification, your program is very well diversified. You're invested in a lot of different things. And what we're seeing today is the sectors that are still providing positive returns are very niche sectors that show up in that other categories. We look at your portfolio broken down by property type. So things like manufactured housing, student housing in Europe, the retail sector, which is a sector that's broken out here, but it was out of favor, if you recall, really going before COVID, but even after COVID, when everybody started shopping online significantly, and so
they call it sticks and bricks retail, came out of favor. And those assets started correcting earlier, and they're actually performing much better now because they had their market value correction associated with COVID. So it's a lot of the nichier property types or things that we haven't been focused on a lot in this portfolio that are really kind of holding up better. And that's where the positive returns are. But overall, the market has been struggling for the last 2 years as of June 30. Now, if we turn to I think the only other thing I wanted to cover today really was just compliance. We always talk about your portfolio being compliant, and that's on page 600 in your materials. The only issue that we're really focused on in your portfolio is boosting the market value at this point in time. Everything else is in compliance with your guidelines. We are moving per the structure study that this council approved. We are moving and tilting the portfolio towards a little bit more value-add, tactical-oriented strategies, but the portfolio as of June 30 was still 57% core and 43% tactical non-core strategies, and we're working towards really flipping that over the next 3 to 5 years as all that capital that you've been committing is invested. So with that, I'll stop there and answer any questions you have.
I think the one thing that you left out was June 30 is obviously the end of the fiscal year, and there was a new benchmark in the structure study, reporting going forward will look like.
Good, okay. Any questions on the real estate PMR? Hearing none, thank you very much. We'll move on to item 5, our CFO report. Sure.
Mr. Chair, I just want to touch upon the 4th item on the list. I think the other items we can not talk about today. They're pretty self-explanatory. Just wanted to note that we did have an audit exit conference last Friday, November 22nd, with Moss Adams and the audit committee. We're on track to file our audit report with both OSA and DFA by end of business tomorrow. Just for everybody's information, those reports are filed and are not public until they review them and give us instructions that they can be released. So there's more to come in January as far as the audit report is concerned. And I just wanted to thank the audit committee for their involvement with the exit conference. I know Mike Everett and Chairman Nicteas was there for that audit committee, and I really appreciate that. That's the only thing I have today.
Thank you very much. Chairman Tejas, or anyone else have any questions or comments?
No, Brett, just to follow up on what Brett said, we went thoroughly through the audit report, the draft financial statements, and that's a part of required communications from the auditor to the audit committee. So that went very well, and I just would like to commend the staff in the accounting office. They had they've had an enormous amount more of funds that they're looking at and dealing with and having to manage, and so they're doing a really great job with that. So just want to recognize those folks. We don't see them often, so I did get to meet them in the audit committee, so that was a nice thing. Thank you, Chair.
Thank you very much. Thank you. All right, that takes us to closing matters. Any old or new business from any of the members?
Yeah. Just as a trustee of the people of New Mexico, want to express for the people a gratitude to the staff, the hard work you do, preserving that the prosperity that is in your hands for the people of New Mexico. Thank you for the hard work you do.
Thank you very much for those comments. All
Ms.
concur. Yep, Madam Treasurer.
In the spirit of giving thanks for our next Thanksgiving, I just want to thank everyone and all the partnerships and collaboration I should have probably said something sooner when the room was filled because it takes teamwork to make the dream work, and there's a lot of people involved internally and externally to manage such an extensive program. So I just want to thank you all and wish you all a very happy Thanksgiving.
Thank you very much. All right, our next SIC meeting is Monday, at 8:30 a.m. at 1209 Camino Carlos Rey here in Santa Fe, New Mexico State Library. Do we have any public comment today?
Mr. Chair, we do, request the treasurer once twice. We have a representative from Avante Capital Partners, and I believe they're joining us on the Zoom today.
Great.
Yes, hello, good afternoon. Can everybody hear me?
Yes.
Wonderful, wonderful. Oh, thank you so much for having me. I really appreciate it. My name is Evelise Rodriguez-Simon. I'm the managing partner of Avante Capital Partners. We are a lower middle market private credit fund. And the reason I'm here today is because I represent a group of investors that many pension funds do not get an opportunity to hear from directly very often. So we are a smaller fund. We're less than $1 billion in AUM. We invest in the lower middle market. So we support small companies, which really are the engine of our economy. And we're diverse owned manager. So we are the largest Latina owned credit manager in the country. And so funds like ours represent very interesting opportunities for pension funds like the state of New Mexico to generate above average returns. In fact, our fund, Avante Capital, was ranked the third best credit fund by PitchBook globally, above far larger funds. And so I thought, it would be interesting to share just a bit about ourselves, about how there are a number of funds out there that are either smaller, kind of under the radar, diverse owned. So at this point, there are over 1,000 funds that are owned by women or people of color. They range from very small venture capital funds to middle market buyout funds and private credit funds like mine. And they are interesting opportunities for above average returns. So Avante Capital was established in 2009. We are, as I mentioned, we're Latina, women owned. About 90% of our team are women or people of color or both. We believe it's actually generated and created a significant differentiation for us. So we have a very large network of women that we source from. And about 65% of the deals that we have closed have been sourced through that women's network. So we've invested about $1 billion over the last 15 years. We have 0 loan losses. We've never lost money on any of our loans across over 65 platforms and 100 add-on acquisitions. And we are raising our 4th fund. We have very significant demand, and it's been great fundraising. We're going to be closing that in the next couple of quarters. But again, just wanted to come and introduce ourselves and just introduce sort of the diverse manager asset class, because it has been growing and there's a lot of really interesting opportunities. Did anybody have any questions, or treasurer, is there anything that I can help?
No, we don't ask any questions during public comment, but
got it.
So thank you for being here today. Council members, I have been giving discussions and panel discussions all around the United States. And I've invited people who I've never met, who I've never seen before, to come and introduce themselves so that we can become accustomed to the idea that there's all these other people out there that we've never seen, we've never heard about, but yet their rate of return has been very significantly successful. So this was just one of the many people that was willing to come and introduce themselves to us. So thank you for taking up that opportunity. I wish more people would do that. Thank you, Chairman.
Thank you very much. Thanks for presenting to us today. Any other public comment? Okay. Well, can we have a motion to adjourn?
Second.
Okay, we have a motion and a second. With no objection, we are adjourned. Happy Thanksgiving.
Happy Thanksgiving.
Thank you all. Take care.